But I think as we have lots of you already joining us, we're already over 250 of you, I think let's get started. So a big welcome to this half day of training on applying the IFRS Sustainability Disclosure Standards. So my name's Fiona from the UN SSE Academy team, and it's great to be here with you today. So as you'll see from the panel that we have joining us here today, this program is truly a really collaborative effort between a number of organizations. So firstly, a big thank you to the IFRS Foundation, to IFC, and to the Johannesburg Stock Exchange for all of their support in helping us to host today's workshop. And of course, a big thank you to all of you as participants for taking the time out of your busy schedules to join us here as well today. Great. So I'm pleased to kick off the session with a number of welcome remarks. So firstly, it's been my pleasure to introduce Loshni Naidu, who is the Chief Sustainability Officer at the Johannesburg Stock Exchange. So again, Loshni, a big thanks to you and your team for hosting today's session, and over to you for some opening remarks.
Thank you, Fiona. Good morning to all of you joining. On behalf of the JSC, it is my pleasure to welcome you to today's session on the IWSB standards. We are delighted to have such a large and diverse audience with us. The timing of today's session could not be more appropriate, given the recent engagements with the DTIC and SIPC on the possible future of S1 and S2 for South Africa. So your presence today is vital to equip yourself with knowledge to effectively participate in future conversations as South Africa charts a way forward. And I guess this is relevant for many of you who are in other jurisdictions who are having similar conversations. So today's workshop will be facilitated by the UN Sustainable Stock Exchanges Initiative, the IFRS Foundation, and the World Bank's IFC, whose capacity building efforts and support I would like to applaud. Thank you so much for programs such as these, which further not just knowledge sharing, but promote transparency and accountability as standard practices across markets. So over the next few hours, you will hear from experts who will walk us through core concepts of IFRS S1 and S2 and examples of good practice. We encourage you to ask questions, engage in discussion, and make most of this platform. To everyone joining us today, thank you for your time, your commitment, and the important work that each of you do in advancing sustainability. We hope that you leave today's session with greater clarity and confidence, and with practical tools that you will apply within your organizations and in ecosystems that you operate. With that, let me officially welcome you again. Thank you for being part of this global learning community. Thank you once again to our partners. Over to you, Fiona. Thank you.
Great. Thank you so much for that, Loshni. Much appreciated. And great to be here with you. Excellent. So I'm also very pleased that we're joined today by Dr. Ndidi Anoli Edozian, who is a board member of the ISSB. So great to have you with us as well, Ndidi, and the floor is yours.
Thank you so much. Great to be here as well. We're already 381. And, you know, I think Loshni said everything. I'm always excited when I get to join these sessions and open them. So you're in for a treat. And they've really been applauded in terms of the level of detail that they go into and the level of passion of the presenters. So as usual, it's the UNSSE who we're very grateful for, and in this instance, it's the JSE as well. And as Loshni says, this is great timing for South Africa, for the region. Yesterday, I was in a session with Tanzania that was facilitated by the IFC and the World Bank. And this was about IPSASB, which is the Public Sector Accounting Standards Board. And one of their board members was presenting alongside me. And it was fascinating, the synergy between the public sector accounting standards and the ISSB accounting standards. And it's so important that, you know, the private sector and the public sector are aligned in terms of their direction of travel. And what's also really exciting is that when we talk about IFRS S1 and S2, we're not talking about compliance. We're talking about ensuring that there is decision useful information that is comparable and can be used to drive trade, investment, competitive advantage for businesses without undue costs and effort. That means ensuring that proportionality, which is very important for our markets on the African continent, is key. What's also really exciting at the moment is this is board week. Normally, I'm not allowed to do anything other than board week. but this was just too important to pass off. And I will tell you what excited me the most about our papers this week. So, whereas in, I think it was December 2023, the Agenda Priorities paper shaping the future of the ISSB standards, Africa's participation was a grand 0%. I couldn't believe it and I almost died. And I can tell you now that for the recently closed industry-specific consultation, Africa's participation in comment letters was 18%. 18%. That's a huge jump from 0%. And it means that we're really stepping up to shape those standards. Wanted to say a word of thanks to Valdine Reddy, who's going to be the new CEO of JSE, for her participation in the CEO roundtables we had last year and also the B20 side event. I know how hard it was for her to do that. And also really a shout out to Loshi and Tanya, who joined us during the workshops just last week for 3 days, led by DTIC and CIPC, workshopping the roadmap development tools. Again, something that is new. So we've done these workshops where we share the tools of readiness assessment, of jurisdictional adoption rationale, the why. Why are we doing this? Because when you get the why right, then actually the motivation to understand the ISSB standards becomes more compelling. And very importantly, once you understand the ISSB standards, and this is where I'm going to close, then it also becomes very powerful in terms of leaning in to help to shape those ISSB standards. Because it's not that they're written somewhere far away from you. The ISSB standards are being shaped and written with you. And plus, you have someone sitting on the board. I sit on the board for you, and I am accessible. So please remember to lean in because we started with IFRS S1 and S2, and right now we're really digging into nature-specific standards that are so important in terms of Africa's risks and opportunities in that regard. And we're also digging deeper and deeper into industry specificity. Of course, South Africa plays an absolutely critical role on this journey. It's the largest capital market on the continent. And of course, you've always been a leader in terms of governance from the King Code. And, the world looks to South Africa for governance leadership. And so S1 and S2 really builds, at least in South Africa and in the remaining 10 African adopting countries, Africa is leading on the adoption of the ISSB standards and also on the shaping of the ISSB standards. And so capacity building and, exploring the economic upside and the theory of change, which is that decision useful information leads to better capital allocation decisions and better pricing of the costs of capital because of the better assessment of risk, which is so important for the African continent because very often the risk perception is too high, is so absolutely critical. And of course, with the proportionality built in, it ensures that it's actually proportionate to those who are applying the standards. So thank you very much for having me here. I wish you a very, very enjoyable session. And even though I'm going to leave now, I will certainly pop in again later to listen in as well.
Brilliant. Thank you so much for that, NDD. And great to hear about all that fantastic work that you're doing in the market already. So yeah, I think hopefully for all participants, a good indication that there's a very good timing to this session in terms of joining us today to learn more about the standards as this work is progressing. So a big thank you both for setting things so well in context for us there. Fantastic. So I'm also very pleased to introduce a few more kind of housekeeping points that I think are useful just to get clear on up front. So firstly, hopefully those of you, I saw a few people mentioning audio problems. Hopefully those have been resolved. I think the majority of people seem to be able to hear us okay, but if you are still having an issue, please let us know just in case it is a wider problem. But otherwise, recommend just testing in your audio settings at the bottom, which microphone or speaker is being used, and perhaps leaving and rejoining the session if there is an issue. As you're already doing, please feel free to keep sharing any general introductions or comments in the chat as we move along. Always really interesting to hear your perspective on what we're talking about. If you have particular questions for the team, it's very helpful if you can please make sure to put those in the Q&A box particularly. The team are going to be responding to questions throughout the session, but if you put those in the Q&A rather than in the chat, that's just a little bit easier for us to keep track of those and respond to you directly. So in terms of our format today, we've got a live 3.5 hour session. We will take a little break in the middle of that session as well, don't worry. We have an optional homework activity that you can take away in follow-up if you'd like to continue your learning. And as I've already mentioned, there's going to be live questions throughout. So please make use of that opportunity to ask your questions throughout the session in the Q&A. We've got a great team of facilitators who will be introducing to you in a moment, who'll be on hand to answer those questions. We really do encourage and ask for your participation in today's session as well. So we're going to be using a number of different forms of interaction through Mentimeter and the polls. So please do take part in those as well. It's a great way to bring your different perspectives to the session and also to really consolidate what we're learning today as well. And you probably are aware that this course is CPD certified, and that means that you can receive a completion certificate, which you can count towards professional membership hours, for example, if you have a professional body membership. To get your certificate, you'll need to complete the feedback survey, and we're going to share instructions with you about how to get that at the end of today's session. So as I've mentioned, just to introduce our speakers today. So firstly, as I've mentioned, I'm Fiona, and I'm very pleased to be joined by my colleague Lois, our senior specialist. Hi, Lois. And alongside the SSE team, it's a great pleasure to co-facilitate today's training with our colleagues at the IFRS Foundation. So a big thank you to Bella and Robert, who'll be joining us and contributing to today's session. Thanks again. And today we're also very pleased to be joined by our colleague Nomkosi from the IFC's team in South Africa. Nomkosi is a corporate governance specialist working in South Africa, really focused on these issues. She's going to speak to us a little bit at the end of the session about the work that the IFC are doing, but a big thank you to Nomkosi for joining us. Okay, so just to cover what we're going to be talking about today, we've got 3 main learning objectives. So firstly, we want to help you to understand the ISSB standards. So fundamentally, what are they? And secondly, we'd like to help you to understand how you can use the ISSB standards. So start to think about how you can put the disclosure standards into practice. And then finally, we'll be working through the steps that you need to take to develop a disclosure plan to apply the ISSB standards in your organizations. And then to help us make kind of those 3 objectives a little clearer, we've developed a 4-module structure that we're going to be working through in today's session. So just to talk you through quickly those 4 different modules that we'll be working through. So firstly, we have prepare. So this is all around building on existing knowledge that you might have of the sustainability reporting landscape, thinking about the purpose of sustainability reporting, how our landscape has evolved to meet the global baseline that the ISSB standards put in place. In our second module, Align, we're then going to be really starting to think about how we can apply and use the standards. So understanding what the contents of the standards are and what additional disclosures you might also need to add on top of IFRS S1 and S2 to meet geographical, sector or regulatory requirements. In our third module, Implement, we're really going to be going into the practices and systems. So thinking about how to identify, evaluate and integrate sustainability-related risks and opportunities into our businesses and strategy and see that come through in our disclosures. And then finally, in Communicate, we'll be thinking about the overall format of our reporting. So where to put the information, the timing of which to report, and how to do so with efficiency and in a way that promotes user confidence in that reporting. And this is just to show you the same thing, but in terms of how our time breaks down across the agenda today, we'll spend a bit of time on each module, in particular some extra time on module 2, which is where we really talk through the detail of the standards and what they're containing. As I said, we've got a bit of time for a break in the middle, and then we'll wrap up at the end with that homework and some additional resources. But as I've said, there's no sort of dedicated time for questions, but please do continue to ask your questions as we move throughout the session in the Q&A, and we'll respond to those as we go. So just a few more key things to mention. Firstly, the training materials from today's session. So that's this slide presentation we're showing you now, and that optional homework assignment can both be downloaded from the event page for today's session. So I'm sure we've shared it already, but we'll share that link with you in the chat a number of times. And if you go to the resources section at the bottom of the page, you'll be able to access this presentation as a handout. You can get links there to all of the resources that we're discussing today. We'll also share a number of links in the chat as we go along. After the session, we'll also publish the recording of today's training on that same as well. Thanks to Lois, who's just reshared that link again in the chat with you. And as I've mentioned, so there's an optional follow-on that you can do after today, which is a homework assignment. And the homework is all around developing that disclosure plan for your company. So putting into practice what we've learned today and hopefully helping you to start to take this forward. So just to say, this isn't mandatory to do this. There's no need to submit it to us. It's not going to be checked. But this is something we've developed that hopefully can help you to continue your learning. So you can find that, as we've said, on the same page that Lois has just reshared with you. And we'll talk to you a bit about that later in the session as well. Just to highlight a final resource from the SSE that we've put together, we have a sustainability related disclosures toolkit of resources that we've developed in partnership with the IFRS Foundation to support you on this topic. So you can find these publications on the SSE webpage or also by following the QR code that you see there. So be sure to check those out as well if you'd like to use these additional resources to help you with your implementation of the standards. Okay, so just before we sort of dive into the content, I have a couple of quick warm-up questions for you in Menti. So we're going to be using Menti a number of times for interactive engagement throughout the session. So recommend taking the time to find your way into Menti now, and we'll come back to it a number of times. So the easiest way to get to Menti will be to follow the link that Lois has just shared with you in the chat. And then I'm going to share my screen now as well. And there'll be a QR code that I can just put up. That will also be another way that you can join us. Great. So the first question, once you get into Menti, is just to get a sense from everyone who's here today of what your reasons are for joining us, maybe what you're hoping to get out of today's session. So you can just share a few words that come to mind for you, and maybe driving what you're keen to focus on in today's session. Great. I see lots of you joining us, which is brilliant. So great to get as many of you into Menti as we can and taking part in the interaction. So, as I said, encourage you to join us now. There's a final way to use Menti that I didn't mention actually, which is go to menti.com and you can enter that code that you can see on the right-hand side of the screen and at the top of the screen as well. So the link in the chat is the other option too, as well as the QR code. Great, lots of responses there. So thanks very much, everyone. So I'm seeing understanding, learning, compliance is coming up there. So maybe thinking about getting ahead of what might be coming down the track, development. Oh, the words are getting so small. There's so many. I'll just have to look over here. Oh gosh, yes, fantastic. Curiosity, reporting, preparation, connection, insight. Someone wants to do the homework already, so that's great. You're eager to do that. Fantastic. Thanks, everyone. Lots of great words there, and hopefully things that we can all help move forward on together today as well. Okay, so second quick warm-up question is just to get a sense of those three kind of learning objectives that we want to talk about today and getting a sense of how comfortable you are already with those. So you can use the sliding scale just to rate these from the left-hand side, maybe not familiar at all and just getting started, to already very experienced on the right-hand side. So let us know where you're at today with being able to explain to your colleagues what the ISSB is, on using the ISSB standards, and on developing a sustainability reporting strategy. So just useful for us as facilitators to get a little bit of a flavour of where you're at currently. There's no right or wrongs here, of course, and we're here to learn. But yes, looks like for most people, we're somewhere in the sort of 2 out of 5 level on most of these areas, and maybe least familiar with specifically using the ISSB standards. Of course, makes a lot of sense as to why you might have joined us here today. Great. Thanks for letting us know that, everyone. And we'll come back and see how we're doing on that at the end of the session as well. So let me reshare the slide presentation now, and we'll kick off with our first training module together. Thanks everyone for taking part in that. I'll say keep that Menti window open in the background, and we'll come back to that later in the session as well. So before we dive into the content, I have a quick disclaimer just to share with you all. And this is just to be clear about how we're going to be using examples in today's session. So these are really just here to add a little bit of an illustration or color to what we're talking about, because we know that can be helpful to see how to put into practice what we're talking about. However, the examples that we share are just that. They're not necessarily the best or indeed the right way to approach this topic. So please remember, of course, that you need to report on these things in the way that is most appropriate to your company's specific circumstances. Okay, so kicking us off then with our first module on prepare. So as I've said already, this is all around that solid foundation of knowledge, and you probably already know a little bit more about these standards than you might think. So let's have a look at that together. So there's three different areas that we'll cover at this point. So firstly, the purpose and why to disclose sustainability related financial information. We're then going to look at the landscape, so thinking about the different frameworks and standards that existed and how these have evolved and simplified to reach the development of the ISSB baseline. And then we'll finish off the unit by introducing that global baseline. So that's the core concepts and requirements that sit within the IFRS S1 and S2 standards. So to get us started on why and purpose, I've got a quick question for you all, which I'll just launch in the poll, which is really to get a flavour from everyone here as to what your reasons are for disclosing sustainability related information if you're already doing so, or maybe just why you're interested in this topic and why you're joining today. So you can select more than one option here if more than one applies to you, but let us know which of these reasons here might be most front of mind for you. And feel free to share in the chat as well if we've missed any reasons there that are particularly pertinent for you. And as I've said, maybe you're not disclosing yet, and that's okay as well. So you can let us know that in the option at the bottom if you'd like to. Okay, I'll give everyone a few more seconds to respond before we look at those results together. Okay. Right, I'm going to close the poll there. And let's have a look at the results. We're going to do a number of polls, so get used to those popping up, and we'll try to give you as much time as possible to answer those. So it looks like for most of you, the regulatory requirements piece is just coming out as the top option, and then investor interest as a close second as well. But a number of you saying that you're also interested in sharing your own organization's management objectives. So great to see that, as well as that drive that you might have from kind of external forces to report this, you're also thinking about some of the internal reasons why this might be valuable. But yeah, I think that's quite a common picture globally that we see that really that regulatory driver regarding the move towards mandatory adoption of the standards is quite important here. So thanks for sharing that with us. Okay, so let's have a little bit of a look at some of these drivers. So a lot of you did mention that investor interest in this topic was quite key as well. So looking at this topic, why is it that investors are particularly interested in this, and how has that changed over time? So we're just showing you a little bit of data here that comes from the Principles from Responsible Investment Signatory database. And we can see that if we look back over maybe a sort of 5 or so year time frame, the number of signatories to these principles has grown significantly. It's leveled off a little bit in recent years, but we have overall seen a big uptick in interest from the investor community in these topics. And so what is it that's really driving that interest? Well, I think what's important to say is for many investors, the interest in this topic is really coming from the fact that the potential financial effects of sustainability related issues are becoming increasingly apparent. And there's a growing recognition from investors that this topic is highly relevant to long-term value creation and strategic resilience. So the data we're showing you here comes from a recent study of institutional investors, which was conducted by HSBC. And amongst the respondents to this survey of investors, it was found that the top driver for incorporating climate change and environmental issues into their investment strategies was the perceived impact of these factors on long-term performance. So you can take a closer look at the study in the handout if you'd like to. There's a link at the bottom of the slide to more data there. But before we move on, let's firstly have a quick look together at what we might mean by financial performance, which is one term we've already started to mention there. So an important thing to keep in mind today is that we're going to be talking about disclosing financially material sustainability related information. And so later in the workshop, we'll talk in more depth about what we mean by material. But we want to be clear from the start about the types of financial effects that investors are looking for disclosure on here. So starting with effects on a company's performance, we often see these in the statement of profit or loss, which shows us income or revenue and expenditure. And sustainability related risks and opportunities can have a financial effect by changing the revenue mix or total revenue of a company, for example, if demand for its products and services change. And we can also see changes in relation to expenditures, for example, if operating costs increase, or maybe there's a need for greater investment in R&D to capitalize on new opportunities as well. You're also going to hear us mentioning effects on financial position today. So we can see these effects coming through on a company's balance sheet, known as a statement of financial position. So, for example, a company could see changes to certain assets or liabilities due to climate issues. It could see changes in portfolio value or possibly even write-offs of certain assets which may be damaged or needed to be repriced. And then there could also be changes to financing and the cost of capital. So that can include, for example, equity valuations that could be impacted by sustainability related risks, or also making use of new financial structures such as green bonds or social bonds. And so before we move into the next unit of this module, just a few key concepts to finish off on in relation to risks. And the first is just to highlight that the risks that we're going to be talking about today, the time horizons can be a little bit different than we're used to. So firstly, you'll see here the latest data from the Global Risk Perception Survey from the World Economic Forum. And you can see here that those risks that are the most kind of front of mind on a short-term basis can be quite different to those risks that might be seen as most significant over a 10-year time frame. And so what's important for our disclosures is that we're preparing for those longer term risks. But actually what we might see as well is that although a risk may not be expected to occur until a longer term time frame, financial effects could be felt sooner. For example, if we need to take action now to invest in mitigations or indeed ways to capitalize on an opportunity as well. And a final point just to highlight is the interconnectivity between these different risks types. So this is a second diagram coming from the World Economic Forum's report, and it really just shows how interconnected different sustainability related risk topics are. So this is something, I guess, that's quite important to keep in mind as we move through today's session. So we might be talking with the ISSB standards about separate disclosure topics of climate change and other sustainability issues. But what's important when we're disclosing and preparing our reporting is that we're thinking about the interconnections between these issues as well. Great, so that's just a few key things to highlight to get us started. And now I'm going to pass over to Lois, who's going to talk us through a little bit more about the reporting landscape.
Yes, thank you, Fiona, and hello, everybody. So Fiona has explained to us why the reporting standards are important because of the interest in the information from investors and because of the risks involved that are related to sustainability. So now we're going to look at how the IFRS sustainability disclosure standards developed in the landscape of existing reporting standards. But before we do, we're interested in hearing which standards and frameworks you're currently using for sustainability disclosures. So please select all that apply here. Do you already use IFRS S1 and or S2? Do you use the Global Reporting Initiative standards, the Integrated Reporting Framework, the Sustainability Accounting Standards Board standards, the recommendations of the Task Force on Climate-Related Financial Disclosure, any regional standards, or anything else. And please let us know in the chat. You already see someone referring to the European directive. Some of you not using any, some a mixture of different things. Let's have a look at what you've told us. So I'm going to share the results, and you can see there's quite a mixture of practice amongst this audience, as we would expect with such a large audience. So the majority, I think, are using integrated reporting, which was very widely adopted in South Africa. 31% of you already using IFRS S1 and S2, that's great. 49% using GRI, and then a mix of others. So quite a mixed practice here. So thank you for sharing that with us. We're now going to go and have a look at the structure of the IFRS Foundation, which is the institution that has developed IFRS S1 and S2. The IFRS Foundation is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. At the bottom of the screen, you can see the Foundation hosts two independent standard-setting boards. The International Accounting Standards Board, or IASB, was formed in 2001, and their standards are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board we're talking about today was formed in 2021 and released its first two standards, IFRS S1 and S2, in 2023, following strong market demand for its establishment. So the two standard-setting boards work closely together within the foundation to ensure that financial and sustainability standards complement each other. Governance of these standard-setting bodies is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did S1 and S2 evolve? Well, this slide looks a bit confusing perhaps, but the message to take from it is it's actually a slide that shows us a picture of standardization and harmonization. I'm sure you'll recognize many of the logos you see all this on the screen, and these are organizations that have all contributed to the evolution of sustainability reporting. They have a lot in common, but sometimes their objectives and guidelines differ. So most of the organizations you see here focused on eliciting information for investor information needs. GRI, of course, asks for information that serves the needs of a broader range of stakeholders. Now, but the arrows that you see point up to the IFRS Foundation, and that's because many of these organizations have either been consolidated into or work very closely with the ISSB. So, for example, the Transition Plan Task Force, its materials on disclosure are now the responsibility of the IFRS Foundation. The TCFD has finished its work and has disbanded, and all of its materials have been incorporated into the IFRS sustainability standards and other materials. Integrated reporting, that organisation was consolidated into the IFRS Foundation along with the Climate Disclosure Standards Board and SASB. CDP has aligned its climate questionnaire with S2, and GRI is working very closely with the IFRS Foundation to ensure that the reporting landscape is as simple as possible and aligned as possible, and that the reporting burden for companies is reduced as much as possible. So there are still differences between some of the reporting standards and frameworks. So can we ask you to select all of the answers that apply that explain why that might be? Great to see so many of you participating so quickly. And don't forget you can select all that apply here. So if you think there's more than one answer, go ahead and select all that you think apply. I'm going to share the results with you now. And you can see we've got a mix of answers here. And in fact, all of these answers are correct, A to E. Differences exist because there are different reporting objectives, such as the objective of GRI to ask for information for wider stakeholders, whereas IFRS focuses on investors. Difference in scope, and that can be subject matter scope, differences in definitions, how the different organizations define different terms and concepts, differences in wording, but sometimes actually meaning the same thing, it's just a wording preference, and of course differences in the way in which materiality is defined and understood and applied. So still some differences, but really, as I said before, a picture of harmonisation. Good example here is what I mentioned earlier, that the TCFD's recommendations are now reflected in IFRS S1 and S2 in terms of architecture and content. But in some cases, S2 uses different wording than the wording in the TCFD recommendations, but to capture the same information. S2 requires more detailed information in some cases. That might be, for example, asking about how carbon credits are used to satisfy carbon reduction targets. And so S2 provides some additional requirements and guidance, in particular on sector-specific disclosures. Now, the ISSB's goal in setting the standards was that they should form a common language and a global baseline for sustainability-related financial information that would enable comparable and consistent sustainability disclosures across global capital markets. And the Foundation is working with jurisdictions around the world to achieve this. However, of course, the Foundation recognises that in some jurisdictions there will be information requirements that regulators and stock exchanges wish to add, and that information might be required to serve multi-stakeholder needs. And therefore, information may be required to meet those needs, and they're added to the global baseline reflected in ISSB's standards using the term we use is building blocks. So you can build these additional requirements on top of the ISSB standards. And this means that there's a globally consistent baseline of disclosures for capital markets reflected in the ISSB standards, while still allowing companies to report and regulators to request additional information based on standards like the GRI standards. There's been global backing for this approach reflected in the ISSB standards. So, for example, IOSCO, which is the International Organization of Securities Commissions, has endorsed the ISSB standards and asked their 130 members to consider how they can incorporate the standards into their regulatory frameworks. We've seen new assurance standards emerging, in particular ISSA 5000, to support assurance of sustainability information. As part of its regulatory implementation program, the Foundation is working with jurisdictions around the world who are planning, preparing for voluntary and mandatory adoption of the standards. And of course, the Foundation is working with market participants around the world to support voluntary disclosure through initiatives like our work with the Sustainable Stock Exchange today and this training program. So I'm going to hand over to Bella now, who's going to start taking us through some of the details of the standards.
Oh, thank you so much, Lois. Okay, let's continue with the next slide. So now we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it's important to note that there are some key terms that should be understood. You can find the definitions in your handout, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can be information about a broad set of issues, including climate, nature, or biodiversity, human, social, or others. Sustainability-related financial information is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. In terms of sustainability-related risks and opportunities, they are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. In other words, it could affect the company's prospects. We will also refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, management discussion and analysis, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Here we have just summarized the key points of each term, but you can also refer to S1 for fuller definitions of each of these phrases. Okay. Anyone familiar with TCFD will recognize the same four core pillars or content areas for the SSB standards. These are governance, strategy, risk management, metrics, and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the four content areas today, and I encourage you to download the standards as part of your homework assignment. Okay, and now let's start with IFRS S1, or to give it its full title, General Requirements for Disclosure of Sustainability-Related Financial Information. IFRS S1 sets out general requirements for the content and the presentation of material information about sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. For matters other than climate, S1 asks preparers to refer to and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information about them. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. And finally, the standards can be used in conjunction with any accounting requirements. So let's look at IFRS S2. The scope of S1 is all sustainability-related risks and opportunities, and S2 focuses on climate disclosures, building on the same foundations of S1. For example, S2 fully incorporates the recommendations of TCFD. It sets out the requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, these include both physical and transition risk, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2, such as the SASB standards. These are organized by industry, enabling a company to identify climate-related disclosures topics and metrics applicable to its business model and operations. Okay. So it's really important that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. And next, let's consider some of the conceptual foundations that underpin the SSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the SSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And the fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And the reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The SSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between disclosures in the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. So it's time for an example. So over to you, Lois.
Thank you, Bella. And because this is our first example in the training today, I just wanted to remind everybody of the disclaimer that Fiona gave earlier, that we use examples to illustrate and to inspire you, not to suggest that there is any particular best practice at the moment, because the standards are still relatively new. But this example we have here from BHP's 2024 annual report is to demonstrate some of the connections that they draw between their decarbonisation and investment processes. So the extract illustrates connections between the company's decarbonisation strategy, its financial results, and other processes. The first paragraph tells us that climate risk assessments and climate scenario analysis are integrated into the company's strategy and treated as a sensitivity in their capital allocation process. Connections and alignment between the company's capital allocation plans and a rapidly decarbonising global economy are also considered. So the climate scenario analysis and risk assessments have not been conducted in isolation from the rest of the company's strategic thinking. In the second paragraph, they tell us that some of their assessments are still in progress. So they're assessing the effect of future physical climate-related risk on the company's operations, productivities, and costs. So when they have the results, they're going to use them to inform and therefore connect with the company's risk profile, corporate planning, controls, and adaptation measures. So you can see that they are connecting existing processes with the future results of their physical climate risk assessment. The light grey text at the bottom shows us that where we can find connections to further information on the impacts of climate-related risks on operational activities, GHG emissions across the value chain, financial statements, and production revenue and expenditure. So this extract is just one example about how the effects of climate change are being connected with wider business decisions, strategies, and plans about standard business processes on operations, risk controls, and finance. So it's back to you now, Bella, to take us through a Zoom poll, I think.
Thank you, Lois. You are right. It's time for a Zoom poll after an example. Okay, so the Zoom poll has been launched. The question is, what information should be considered for connected information? Just to remind that it's multiple choice question, so select all the answers that you think is right. Okay, so is it connections between governance strategy, risk management, and metrics and targets? Or the connections between sustainability-related financial disclosures and the financial statements? Or the connections between sustainability-related risks and opportunities? Okay, so just wait for a few more seconds. Okay, yeah, the participation is still increasing now. So let's wait for a few more seconds. Okay, so I'm going to end the Zoom poll now and share the results. Okay, so well done, all of you that have participated in the Zoom poll. So the correct answer is all of them are correct. And just to remember that I introduced a few minutes earlier that in the slides of conceptual foundation that it's important to know that there are three aspects in terms of the connections. So the connections between the four content areas and sustainability-related financial disclosures and financial statements, and also the risks and opportunities. Okay, so let's continue with the slides. The standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we will be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the SSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The SASB standards were used to create industry-based guidance accompanying S2. The FSA credential was also updated with more plan to come. I should also note that IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so now let's do another Zoom poll. Is about water. Water is a vital input to your business, but the SSB standards do not currently have a specific standard on water. What do you do? And it's a single choice question. So which means there is only one correct answer. So what do you do? Is it do not disclose anything about water or consult the sources of guidance listed by the ISSB or engage a consultancy to help or copy your competitors' reporting? Okay, it's already 60% participation. So I'm going to end the Zoom poll now and share the results. Okay, so well done again. I think most of you have chosen the correct answer. The correct answer is option B, consult the sources of guidance listed by SSB. So I just noticed that in the Q&A box, there was a question about water and nature related information. Yes, the SSB is working on the standards or the guidance that build on the TNFD. In the absence of thematic standards, so we use the IFRS 1 to assess whether water is material to your companies. So in this case, water is a vital input to your business, which means it might be the material information for your sustainability disclosures. So the first choice for you is to consult the sources of guidance listed by the SSB, like the SSB standards and the other sources of guidance that you think is helpful. But for these questions, someone may choose option C and option D. I think they are also helpful, but for these questions, option B is your first choice. Okay, so let's continue. I think it's time for Fiona to do a module 1 summary. Over to you, Fiona.
Great, thanks so much, Bella. Before we finish up this module, I'm just going to take a few moments to review what we've covered so far with you. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway that we're hoping that you leave this workshop with is that there are important benefits both internally and externally for collecting and disclosing sustainability-related financial information. So if you're not aiming to make good use of that data that you're collecting to improve your strategic decision making, you're really missing an opportunity here. And if you also have operations in difficult to abate or high impact sectors, it could already be that your competitors are disclosing risks and identifying opportunities that they're pursuing. And so that's going to leave your investors perhaps starting to wonder why you're lagging behind and not identifying and managing those same issues, which in the long run might start to affect your equity valuation or your ability to access capital. And next, we then looked at the evolution of disclosure standards on the formation of the ISSB with that aim to simplify the landscape. And when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB, but rather building on top of them. And finally, we introduced the standards and the important concepts that you need to understand in order to use them correctly. And so a key point that I want to reiterate here is that the standards and the guidance that come with them are designed to meet the needs of investors. And so they're heavily focused on those prospects that we discussed at the start of the unit relating to financial effects, financial performance, etc. So do keep in mind that is the audience that we're thinking about here. Okay, so to wrap up the module, we've got a quick exercise that we're going to do together. And so we're going to do an exercise for each module, and these will connect into the same themes that we're asking you to think about in the disclosure plan homework assignment. So if you want to start developing that disclosure plan, we're hoping the exercises today can at least get some of the ideas moving that you'll need to do that. And so the first activity from our kind of first module is thinking about defining objectives for your sustainability disclosures. So as we said, there's quite a few different reasons why you might be thinking about these issues. And it's helpful, we think, at outset to be clear internally with your colleagues and perhaps externally as well as to what your goals are with your sustainability related disclosures. So you can have a little bit of a think here and let us know in the Menti what you would set out as your goal here. And so when you're setting a goal, you want to think about, I guess, the particular reporting requirements you're seeking to meet. Maybe that's directly adopting the ISSB standards on a voluntary basis. Maybe it's particularly responding to the regulatory requirement in your jurisdiction. And you'll also want to think about where you are now versus where you need to get to. So for those organizations that maybe have well-developed sustainability reporting, it could just be an exercise of aligning your disclosures to the new requirements. However, perhaps if you're starting at an earlier point in the journey, there might be a greater degree of change that you need to make here. And so maybe you need to set yourself kind of a more ambitious goal there. So the question in Menti is just have a think about what are the objectives that you're aiming to achieve through your sustainability disclosures. So thank you, Lois, for re-sharing in the chat the access to the Menti, and I'll just share the screen again now so we can have a look at the answers together. Okay, I see some responses already, so thanks everyone for getting going with thinking about this. For those of you still having a think, I'll let you do that, but let's have a little bit of a look at what people have said already. So someone's mentioning that they'd like to understand how to deliver useful sustainability information backed by practical implementation. Yeah, I think that's a good partnership of things to keep in mind. Of course, disclosure is about informing our stakeholders, but it's also really important to truth that back to action that we take in our businesses to continue to progress these topics and manage those risks and opportunities. So someone's mentioned about being a good corporate citizen through transparent reporting. So reporting transparently being a kind of a core part of that corporate citizenship approach, I guess, as you mentioned there. Someone's mentioned about particularly investor confidence, maybe being their top driver, which as many of you have highlighted is key. Someone's mentioned that their own objective, I guess, is to understand the standards. Sure, that's a good starting point. And I think once you've got that initial understanding, it's then thinking about, communicating to your colleagues what these standards are, why you need to adopt them, what you can achieve through doing so. Someone's also mentioned around transparent, accurate, and decision useful information to stakeholders. Yeah, so that's a good set of qualities to keep in mind for your information here. Demonstrating accountability and identifying gaps to strengthen stakeholder confidence. Yeah, exactly. So being transparent about those gaps, of course, is really key to being balanced and, communicating that journey that you're on with these issues. It's not about just reporting the good news, as perhaps some companies might have been a little bit guilty of in the past, but providing that balance about, the risks and the opportunities and how you're overcoming any challenges you may see there. So compliance, simplicity, gap analysis. So that's, a clear focus for you there, be compliant. And simplicity is definitely a good word to keep in mind. So focusing on that concise material information. And as you've highlighted, a gap analysis is definitely a good idea to inform that approach for sure. Someone's mentioned beyond compliance, objectives is to ensure that disclosures meaningfully influence capital allocation, risk assessment, and long-term enterprise valuation. Yeah, exactly. I think it's really great to have that balance between, of course, compliance has to come first, but actually, if you get this right, that there is a lot of genuine benefit that you can get from that information. And as you say, that ultimate goal of really connecting these sustainability related risks and opportunities you're disclosing into how your organization kind of allocates capital and runs itself on the strategy and finance level is a really good objective to have in mind as a long-term goal here. Great. Responding to market needs and where we need to get to, that is then a future state. So yeah, thinking, I guess, about the forward-looking view of how you can maybe shape your organization's strategy, business model to better respond to the risks and opportunities you've identified, to be more resilient in the long term is great to keep in mind. Great. Appropriate information to inform decision-making for stakeholders. Great. Yep. Compliance is coming up a few times, of course, and regulatory requirements. few particular topics being mentioned here around net zero and human rights. So maybe front of mind for your organization as issues you know are likely to be material for you. Someone's mentioned maybe they're coming more from a report user perspective, that they would like the private sector to be more consistent and comparable to allow the assessment of leaders and laggards. Yeah, exactly. So if we're at a point with this global baseline where we can really understand that better, I think that is both easier for companies that are taking this forward to be able to demonstrate how they're managing these, but also, hopefully overall raises the bar as well for those companies that perhaps are not moving as quickly. Great. Lots of really good responses there. Thanks everyone for sharing. So if you've got Menti open, I think you should be able to keep scrolling through those in the background if you'd like to have a look. But yeah, I think you've highlighted a lot of the things that we would definitely have recommended here. And it's great to see so many of you as well, considering not just compliance, which of course is important, but more of the wider benefits that you can get out of disclosure as well. So really looking to set out with your colleagues what those other benefits are, I think is really helpful, so that you're all on the same page about what you're trying to achieve here. Great. Okay, thanks everyone. That wraps us up well on module 1. So I'm going to pass back to Bella now, who'll get us started on module 2.
Thank you, Fiona. Yes, now that we have introduced the initial concepts, let's dive into how to apply the SSB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership's objectives. Okay. In order to understand how to ensure your disclosures meet global standards, we will look at 2 key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards as part of the global baseline for sustainability-related financial disclosures for capital markets. Once we cover that, we will also discuss how additional disclosures fit. To begin, let's focus first on how to apply the SSB standards as the global baseline. Let's get started on the first core content area, governance. This aspect is centered on understanding how oversight for sustainability-related issues is providing in the organization through the processes, controls, and the procedures that have been put in place at board and the management level. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements, for example, as part of a gap analysis. So if we look at the governance and the management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. And you can also ask, is management responsibility delegated to a specific role or committee? Another example of question is how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And also we can ask whether progress against these targets links to executive remuneration. For more information, you can make use of the SSE checklist tool, but remember it's not a replacement for reading and using the full SSB standards. Okay, so it's time for another example. Over to you, Lois.
Thanks, Bella. And yes, here we're going to have 2 examples about how companies, 2 different companies report on their governance model. This first one is from Yara International's integrated report. Yara is a big global crop nutrition company with employees working in 60 countries. So as you might expect, we see quite a complex but integrated governance model here. This model shows us that responsibility for governance and sustainability issues is spread across multiple business functions. But let's look at the governance bodies first. In the dark brown boxes in the middle, we see the board of directors and president and CEO are shown there. The board audit and sustainability committee on the far left assists the company directors and in overseeing the processes for an internal control of sustainability reporting and material impacts, risks and opportunities. Then if we look down on the left-hand side in the light green box, we can see the sustainability governance team, and they have a direct reporting line to the chief financial officer. And that governance team are responsible for sustainability performance and reporting, and their work is closely aligned with corporate performance and risk functions. Right at the bottom in this pale box, we see the sustainability network, and this is a cross-functional network that reviews Yara's accountability processes and systems in place for sustainability policies, and they monitor sustainability performance, and that network is chaired by the Chief Compliance Officer. So arrows here are used to indicate the flow of information and input between different governance bodies in the organisation and to show where there are cross-cutting input activities. Now, there are multiple governance models that companies can choose from depending on the type of the company and their regulatory environment. This is just one example, and of course your organisation must choose what's right for it. But this is quite an integrated model we see from Yara with responsibility spread across multiple departments. Let's have another look at another example now, and this is from Petronas's Integrated Report 2024, and Petronas is Malaysia's national oil and gas company and a global energy group with presence in over 100 countries. In this example, the governance structure shows the executive, non-executive and independent roles of the board of directors and the three committees to which the board delegates authority, responsibility and operations. So note that climate-related matters are included in the responsibility of all three board committees. The audit committee monitors climate-related reporting, and later in this particular report, you can see that it provides assurance on the state of governance, controls and compliance in relation to greenhouse gas emissions reporting. We've got the Nomination and Remuneration Committee in the middle in the yellow box. And this committee reviews the President and Group CEO's performance scorecard, which includes climate-related measures and remuneration. The Risk Committee also has climate-related duties looking at climate-related risks and mitigations. At the bottom of the image, you can see the executive leadership team's duties include sustainability and that they report to and assist the board. So again, we have an integrated structure here, like the Yara example we saw before, with responsibility for climate and sustainability matters embedded across multiple functions. And this is a structure that aims to provide clarity and accountability about roles, strategic alignment across the group, and to facilitate decision-making at all levels. So with that, we're going to hand over to Fiona now to look at strategy.
Great, thanks so much, Lois. So hopefully those examples helped to make governance fairly clear. But now we'll move into looking at the next core content area, which is strategy. So strategy has got quite a few more disclosure requirements to include than governance, but it's also really where companies can start to see the benefits from sustainability-related opportunities and being better prepared for those risks. So this content area focuses on understanding what the company's strategy is for managing its sustainability-related risks and opportunities. And there are three high-level areas that we focus on in this strategy content area. And those are risks and opportunities, their effects, and resilience. So let's review each of these now separately. So starting with risks and opportunities. So S1 and S2 requirements here are designed to enable users of general purpose financial reports to understand how a company is managing its sustainability related risks and opportunities. And so if we first look at the requirements relating to those risks and opportunities, here are some of the questions that you'll want to be asking internally. So when disclosing information about risks, information required will include a description of the effects, the time horizons over which those effects are expected. And that's where we also need to keep in mind that the financial effect could occur before the risk or opportunity materializes, as we talked about in that example earlier in the session. And they can also change over time as well. And then when we're talking about climate change, there are some particular requirements from S2 as well. So for example, investors will also want to understand what types of risk or opportunity a company has identified. And S2 here uses the categories from the TCFD of physical and transition risks. And both S1 and S2 include guidance to support companies to identify and disclose material information about risks and opportunities. So for example, they recommend using industry-based guidance and the SASB standards. So let's have another example here to see what this risk and opportunity disclosure could look like. So this example comes from Mondi Group's integrated report. And Mondi is a multinational packaging and paper company which operates across Europe, North America, and Africa. And in the left-hand side of the extract, we can see the general disclosure of the risks that the company has identified and how those risks align with 4 different categories. So, for example, strategic, financial risks, etc. They also identify the delegated risks owners, and you can see in the report itself a lot more detailed description of each of those risks. But then within those principal risks, they had identified climate risk as an overall risk type. And so then on the right-hand side of the disclosure, we see a particular summary of the different climate-related risks and opportunities. And that's where they're also using this physical and transition risk categorization, drawing from TCFD and S2. And so for each of the risks, they provide an estimated financial impact range and a time horizon over which they're expecting the impact of the risk to be felt as well. So those are 2 useful aspects that we'll come on to now as well. So I know we've had a couple of questions about this point already and how time horizons work in the context of S1 and S2. So you may remember when we talked about time horizons at the start of the session, I mentioned that time can be a little bit different when we're talking about sustainability related disclosures, perhaps relative to other topics. So let's be sure what we mean by this. So under the standards, you're asked to identify within what time horizon the effects of each sustainability related risk or opportunity could reasonably be expected to occur. And how you define short, medium, and long term is going to vary between companies, and it will depend on a number of different factors. So, for example, the investment and business planning cycles of your organization, maybe the strategic planning horizons that are used to make capital allocation decision, maybe the particular investor assessment periods that are being used, and also the lifespan perhaps of the assets or operations you're running. And so what's important to remember for time horizons is that you do need to define those in the context of these different factors. So your investors won't necessarily know what you mean by short or medium term unless you give them a clear definition for that. And so that moves us on then to the second group of disclosures in the strategy category, which is all around what the effects of those risks and opportunities might be on the business. And so to start tackling the disclosure requirements of the standard here, companies might want to start asking themselves questions such as beginning to describe the effects. They might want to understand the responses that they have planned for mitigating or adapting to the effects that they've identified. And really starting to think about where those different effects might sit in the company's value chain, which particular operating locations may be impacted, or which stage of the value chain. So let's now have a little look at a possible way of approaching this. And so this example comes from BASF, which is a global chemical company. And in this extract, we're just summarizing kind of part of their disclosure on this topic. So, as with all of these examples, it's usually helpful to go away and really look at the report since we can only capture one snapshot on the screen here. But in this section of their report, they talk about the company's overall sustainability strategy, which they call Winning Ways. And the strategy will include supplying customers with products that contribute to sustainability through reducing their carbon footprint. And so the company is prioritizing the projects where it's seeing rising demand from customers and a willingness to pay more for sustainable products. And it's also looking at transformation projects that support the company's own license to operate. And so, among other things, the company is investing in renewable energy to operate its plants. And you can see that in the own production panel in this extract. And the triple S reference in the last part of the disclosure refers to the Sustainable Solution Steering Committee, which is all around streamlining the company's portfolio to support their global sustainability targets. And in the commentary alongside this disclosure, the company also talks about its targets to achieve greater sales revenue by 2030 from products that contribute to the transition to a circular economy. And so they're targeting 10 billion euros in revenue from these products. And then, so this example just really illustrates how those different activities are sitting across the organization's value chain. So it's thought about the different areas in which it's exposed to sustainability related risks and opportunities, and then kind of mapped to the different activities and operations that it has and those of its value chain partners, where it can have kind of meaningful action implemented into its strategy to manage those risks and achieve the opportunities. And so we know one of the obstacles that companies can face when they're reporting on these effects will be the kind of detail that needs to be disclosed. And in that example I just showed you there, mostly we were talking about qualitative disclosure, but what about quantitative information? So a company is required under the standards to disclose both quantitative and qualitative information about financial effects of sustainability risks and opportunities. But the standards do also set out criteria for when only qualitative information is required. So this is permitted if a company can't separate the effects of a sustainability related risk or opportunity from other effects, or also if there's a high level of measurement uncertainty associated with that issue. And finally, if the company doesn't currently have the skills, capabilities, or resources needed to provide that quantitative information. Okay, so that brings us on to the last part of the strategy component, which is all around resilience. So thinking about how the company is prepared for uncertainties and ensuring that it has a long-term strategy to manage those risks and opportunities and can be resilient for the future. And so the disclosures here on the climate-related side are particularly focused on the use of climate-related scenario analysis. And so companies are required to assess their resilience to climate-related risks and opportunities, and to provide disclosure on how they've carried out that assessment, and what the key inputs and assumptions are that they've used to make that determination. So we'll go into scenario analysis in a bit more depth in a moment, but some of the key questions to consider here when you're starting to disclose on this are kind of fundamentally starting to understand how would the company react or adjust to those risks or uncertainties identified, and how could it use climate scenarios to help it to better understand that. So again, let's take a look at an example. So this example comes from Stora Enso, and that's a Finnish and Swedish forest products company. And in these diagrams we're seeing here, at the top of the slide, we see what the sales revenues are likely to look like in 2030. So Stora Enso distinguishes between the essential and the growth businesses in this little infographic. So it really shows how it's expecting to see an increased focus in the future on these growth opportunities and less on perhaps its traditional business of forest products. And so in the diagram at the bottom, they're then showing how they might expect their sales makeup and revenue mix to change from a kind of a baseline in 2006, from today and into 2030, they'll start to see that actually a much lower proportion of their revenue will come from their kind of core business as it is now, and a much greater percentage from its growth areas. And so we're getting a sense here of then how that company needs to transition in order to capitalize on that opportunity and manage the risk as well of the decline in its other business areas. And so in the disclosure, Stora Enso provides a narrative to explain, how it's strategically repositioning its operations and focusing a lot more on renewable materials. And so they talk about some of the actions that they've taken already. So, for example, acquiring businesses that support these growth areas and investing in converting its existing technology and innovating as well. So a second example here comes from Marks and Spencer's, which is a British retail company. And this comes from their disclosure about the impacts of climate-related risks and opportunities on the company's business, strategy, and financial planning. And so there's lots of information about the risks and opportunities provided here that kind of responds to the ISSB requirements. So I'm just seeing a comment about an echo. Hopefully that is not a wider problem, but I'll just move my microphone in case that helps. So in this disclosure, we firstly see a description of the risk and the opportunity. The first risk they're talking about here is a transition risk related to managing environmental compliance. And the second row is both a transition risk and an opportunity. And it's about the company's ability to keep pace with customer trends and preferences for more sustainable product options. And so what we're seeing here is a lot of detail in these columns that explains how the business will be affected by the risk or the opportunity and what the potential financial impacts might be. So I know it's quite a small example sometimes to see on the screen, but just providing a summary here. And obviously we recommend taking a look at that in greater detail in the report as well. But overall, some helpful detail provided by Marks and Spencer here. Okay, so just to wrap up this section then, a quick poll just to test one of the concepts that I mentioned to you earlier. So I'll just launch that for you now. So the question is asking about that point on whether companies need to disclose qualitative information or a combination of qualitative and quantitative information. So I mentioned a number of circumstances where it is acceptable under the standards for companies to provide a mix of information or perhaps just qualitative information as well. So have a think and let me know which of those you think are correct answers. Okay. Give everyone a little bit longer to have a think, but lots to cover, so I won't pause for too long, just in the interest of time. So maybe another 10 seconds and then we'll talk through the answers together. Okay, so I'm going to close the poll there and I'll share the results with you. So the correct answers were both A and B. So as most of you identified, if the company isn't able to separate the effect of a sustainability risk opportunity from other effects, that's acceptable. But also as well, if there is too high a level of measurement uncertainty to provide quantitative information, then that's also an acceptable reason. As most of you identified, the bottom option indeed is not a correct answer. So of course it is important that if we do have quantitative information about possible material negative financial effects, it's clearly important that we provide transparency to our investors on this. And so, of course, in those disclosure examples we just talked about, the companies were providing that balance of information about financial risks and opportunities as well. Okay, thanks everyone. So I'll now pass over to Lois, who's going to talk us through some of the climate-specific aspects of this content area in more detail.
Yes, thank you, Fiona. If when we looked at the governance requirements, you could see that they were quite similar for both climate, the S2 and S1, very consistent. But In S2, there are some specific considerations that apply to some of the content elements and requirements in particular strategy. So we're looking at the additional requirements that apply in S2 in the strategy component. So what are these climate-specific strategy requirements? Well, S2 requires a company to refer to and consider the applicability of industry-based topics. So you can find guidance on this on the ISSB website, and the industry-based topics are based on the work of the Sustainability Accounting Standards Board, so you might know them if you're familiar with that. But you need to look at that guidance to consider which industry-based topics and associated metrics apply to your particular sector. So in the personal products sector, for example, you might be asked about the accreditation of your supply chain, for example, in relation to its sustainability. S2 also requires disclosure of more detailed information about where in the company's business model and value chain climate-related risks and opportunities are concentrated. So, for example, are there particular physical assets at risk from physical climate risks? Thirdly, in describing the effects of climate-related risks and opportunities, S2 requires disclosure about how a company has responded to those effects. So, for example, has the company decided to form a transition plan or to create climate-related targets to achieve its strategic goals on tackling climate change? In providing disclosures about the current and anticipated effects of the risks and opportunities from climate change on a company's financial position, financial performance, and cash flow, S2 sets out criteria for when quantitative and qualitative information is required. So, for example, disclosure of qualitative information is permitted under some circumstances, such as when a company cannot separately identify the effect of the climate risk or opportunity, can't distinguish it from other types of risk, that is, or where the level of measurement uncertainty is so high that quantitative information would not be useful to users of the report. When preparing disclosures on anticipated financial effects, S2 requires a company to use all reasonable and supportable information available at the reporting date without undue cost and effort, or an approach that is commensurate with its circumstances. And this is to make the application of the standards proportionate, as Nadidi mentioned at the beginning of the presentation today. S2 requires companies to use scenario analysis for the purposes of assessing the resilience of the business model and strategy to climate-related risk, but it does not specify the particular scenarios that must be used. That's for the company to determine. So having conducted the assessment of the company's resilience, S2 requires additional information about any significant areas of uncertainty the company has considered in doing its resilience assessment. What is the company's capacity to adjust and adapt its strategy and business model over time in order to enhance or remain resilient? And the standard also asks companies to provide details on how and when and which climate-related scenario analysis or analyses were used. So we talked about the fact that one of the responses that a company can have to the effects of climate-related risk and opportunity is to set a climate transition plan. So first of all, let's look at what is meant by climate transition plan. S2 defines it as an aspect of the company's overall strategy that includes targets, actions or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emissions reductions plans. Now, it's important to say that if a company has a climate transition plan, then it must disclose information about it, but there's no requirement in S2 for a company to develop a transition plan. It's just one of the responses that a company can have to the effects of climate change. So let's have a look a little in a bit more detail about a transition plan. Well, first of all, as it is an aspect of the company's overall strategy, it should align with that strategy and the business case and business motivation and decarbonisation levers that are most economically and technologically feasible for the company to use. It should or could also align with science, and in particular the goals of science, net zero pledges, climate neutrality goals, and Paris-aligned commitments. So many transition plans explain how the corporate plan aligns with wider goals of science. The plan should include long-term transition goals, of course, and those long-term goals should be supported by activities and targets to achieve those goals and interim targets to monitor progress. The transition is uncertain, of course, and so the transition plan should be transparent about dependencies, risks, and challenges of executing the transition plan, and how any residual or unabated greenhouse gas emissions will be treated. The transition, of course, will proceed in different ways for different sectors, and therefore it's useful for companies developing transition plans to look at sector-specific pathways that have been developed by various organisations, and we'll look at that in a moment. And finally, companies should be aware that the transition plan will be evaluated by investors and others, and they should therefore give the plan the hallmarks of credibility that are set out in various types of guidance. So talking about guidance and resources, a few of you have mentioned that you'd appreciate help with this. We're going to look at some of the resources now. I should mention that there are loads of resources on transition planning. The little triangle on the left is simply designed to show that the requirements in IFRS sustainability standards are supported by different organisations, including the work of the Glasgow Finance Alliance on Net Zero, GFANZ, and the Transition Plan Task Force, whose work on disclosure is now the responsibility of the IFRS Foundation. So let's look at some of the guidance now. First of all, the IFRS guidance document on transition planning, disclosing information about an entity's climate-related transition in accordance with S2 is available, and Fiona's kindly provided the link there. That's very comprehensive guidance. Also, the UN Sustainable Stock Exchange has produced model guidance on climate transition plans, and that focuses on practical aspects of transition planning and includes guidance on what are the hallmarks of a credible transition plan. So have a look at that too. We mentioned GFANZ, the Glasgow Financial Alliance for Net Zero. They and others have produced sectoral pathways for different sectors, including financial institutions. So that helps you understand how the transition is expected to proceed for your particular industry. And of course, all of the guidance on disclosure from the Transition Plan Task Force is now on the IFRS website. So if you look at any of these documents, they will help you with your transition planning, but maybe start with the IFRS educational guidance. So after all that, we're about halfway through. You'll be pleased to hear that we're going to have a break. So take this opportunity to have a stretch, have a drink, think of any more questions you'd like to ask us. We're going to play you some relaxing music, and we'll see you back here in 5 minutes. Hello, everyone. Welcome back. Hope you had a stretch and a drink and you're feeling ready for the second half of our training today. So now we're going to move on to look at the third content area, which is risk management. So risk management requirements in the ISSB standards ask about the process that companies use to identify, assess, prioritize, and monitor sustainability related risks and opportunities, and whether and how those processes are integrated into the company's overall risk profile. So the questions that you might want to ask internally to gather information to respond to the disclosure requirements on risk management are: what processes and policies are being used to identify, assess, prioritize and monitor sustainability risks and opportunities, and how, if at all, are they integrated into the company's overall risk management process? So you might also want to be thinking about how internally input and parameters for risk management are set, what criteria are used for prioritization. Is it nature, likelihood, magnitude of risks and opportunities? What the monitoring process is for risks and opportunities, so it's an ongoing risk management process, and whether and how there have been changes to the risk management processes since the last reporting period. So let's have a look at an example now about how BMW, the German car manufacturer, describes its risk and opportunity management process. This is an extract from their 2024 report. The company reports risks and opportunities for the current and subsequent financial year. So turning to the process as summarized in the diagram, around the edge of the circle, we see the term appropriateness, which refers to the risk culture embedded in BMW's core values. We also see in the dark blue circle effectiveness, and that refers to effective management of risks and opportunities that they say in the little inset narrative in the white box that is the foundation of their business success. So already we're seeing, what the aspects of the risk management culture is, that it should be appropriate and effective. On the left-hand side, we see these three circles that show that the group compliance and internal control system form key interfaces to the risk management system. So risk management isn't an isolated process. It's managed with internal control and compliance. The process itself, which we see in the light blue wheels in the circle, involves early identification, analysis and evaluation of risks, using the appropriate risk management tools and measures taken in association with those tools. We see that there's monitoring and reporting of the risks as well in that inner circle. All material risks are reviewed by the Risk Management Steering Committee, which we see in the white circle on the right, and that's chaired by Group Controlling. And any material risks are then reported to the Board of Management and the Supervisory Board's Audit Committee. So you can see the process, the flow of information, the cultural dynamics, who's involved, what happens when the risk has been assessed in terms of governance. Let's look at some of the other aspects of climate, of the climate-specific standard now. So when we look at climate-related aspects of risk management, there are some things to note. First of all, that climate-related risks are actually defined in S2. In particular, the risks are divided into transition risks and physical risks. Transition risks arise from efforts to transition to the lower carbon economy and are often categorized in turn as policy and legal technological, market, and reputational risks. You can see some examples of these in the middle section of this slide. It could be increased pricing of greenhouse gas emissions, enhanced reporting obligations, exposure to litigation, costs associated with the transition to lower emission technologies, changing consumer behavior, uncertain market signals, increased cost and availability of raw materials, all sorts of transition risks there. Now, physical risks include risks from climate change that can be acute event-driven risks, from such as storms, floods, droughts, or heat waves, which we know are increasing in severity and frequency around the world, or they can be chronic physical risks that arise from longer-term shifts in climatic patterns, including changes in rainfall and temperature, sea level rise, reduced water availability and quality, biodiversity loss, and changes in soil productivity. Now, in all cases, for transition risks and physical risks, they could give rise to financial implications for the company, such as costs resulting from direct damage to assets or indirect costs of supply chain disruption. And these financial effects can affect the cash flows, access to finance, cost of capital, financial results, and over different time horizons. Similarly, in S2, we have a definition of climate-related opportunities that refer to the potential positive effects for a company arising from the transition to a lower carbon economy. So these could include efforts to mitigate and adapt to climate change through innovation in the operations, improving processes, being more resource efficient, using lower emission sources of energy, taking advantage of supportive policy incentives, getting access to new markets, and so on. And again, in all of these cases, the company could then benefit from positive financial and reputational effects that can be felt over different time horizons. Let's have a look at an example about climate-related risks and opportunities. And again, there are lots of different ways of describing and reporting on these, but we're looking here at a group called the RS Group, which is a UK-based distributor of electrical and industrial equipment with global operations. And this is an extract from their report, of course. Now, earlier in the report, they've told us that they've identified 10 principal risks, including climate-related transition and physical risks to their business, and this extract just focuses on some of the financial risks. So they tell us that the most significant physical climate risks they face relate to the impact of extreme heat on their distribution centres. You can see that on the first line, number 4. And the potential for extreme weather events to cause physical damage and disruption to their distribution sites and customer supply operations. In the little red wheel icons, the company tells us that how the risk affects their strategy or their strategic actions. So on the first line, there's a strategic action alignment similarly on the second line. They also tell us which stakeholders are most affected by these risks and use icons to describe the stakeholder group. So we know the risk, we know how it affects the strategy, we know how it affects the stakeholders, and that's just in the first column. In the next column, they describe the risk. The third column, they tell us the business owner responsible for the monitoring and management of the risk. In the penultimate column, they tell us the metrics they use to monitor the risks. So the distribution site impacts they're looking at the insurance costs, for example. And in the final column, they tell us the actions, incentives, and progress that they have in order to manage the risk or opportunity, including capital investment, and how they're focusing on these risks in relation to their planning for the upcoming year. So quite a lot there in that example, and we're going to hand over now to Bella to take us through the last core content area.
Thank you, Lois. Yes, you're right. It's now the final core content area of the standards. We will now spend some time reviewing the disclosure requirements on metrics and targets in more detail. Disclosures are intended to enable investors to understand how the company is performing with respect to its sustainability-related risks and opportunities. So let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. For example, what is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? So now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals, as well as any targets it is required to meet for regulatory purposes. Disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. The disclosures also include the metric used to set the target and to monitor progress towards its achievement, the baseline period from which progress is measured, and the period to which the target applies. Disclosures also include what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. Okay, so next, I think Lois will go through an example of CLP. Over to you, Lois.
Thanks, Bella. Yes, this is just a quick one from CLP, which is one of the largest investor-owned power businesses in Asia Pacific, and it aims to be a leading responsible power provider. Now, as Bella said earlier, S1 requires companies to report on all sustainability-related risks and opportunities. Now, to date in this training, we've focused on climate, but here we see an example about a company's waste management and material use targets and assumptions. So the extract shows waste management and material use metrics for 2024, including the percentage of pollution the company reduces and aims to reduce through recycling and removable activities. And this is in line with its circular economy strategy principles. So we see a link here, connectivity between the strategy for circular economy and the targets for reducing waste management and material use. You can see the way in which the nature metrics are reported right at the bottom there. So they're tracking their waste products, their recycling of electrical and electronic equipment, batteries, scrap metal, and so on. You can see their 2024 results, how it compares to the progress that was set out in their targets. And we also see what target they're suggesting by they're hoping for by the end of 2025 and by the end of 2030, and that's described in the narrative above. The other thing I wanted to point out here is that there is currently just a standard for climate and general requirements under ISSB 1 and 2, but here we see that CLP has used SASB and GRI, and they've actually given us the references. They've used SASB and GRI to calculate their metrics. And this is something that the ISSB standards allow while new standards are being developed on different subjects. So back to you, Bella, for more on metrics and targets.
Thank you, Lois. So let's continue with the slides now. Now let's talk about some of the climate-specific considerations for disclosures on metrics and targets. In relation to metrics, IFRS S2 requires a number of specific disclosures, including S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. Additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about the company's financed emissions. In addition, S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IFRS S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the SSE's training tool on this topic. We will share the link in the chat, and you can also find it on the SSE's website. Okay. As for metrics, I think this slide. Yes. Yes. As for metrics, there are some climate-specific disclosures requirements in S2 for targets as well. For example, S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. Okay. Questions on GHG emissions often come up in questions on metrics and targets disclosures. So we wanted to address some of these briefly. And for those who might not be familiar with the different scopes, I'd like to introduce a little bit here. Scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And the Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And for Scope 3 is all other indirect emissions that occur in the company's value chain. S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. And the S2 requires a company to disclose whether and how the company is using an internal price on carbon for decision-making, and whether and how executive remuneration is linked to climate-related considerations. On 29 May of 2025, the IFRS Foundation has published a new educational material presented in a Q&A format, detailing the greenhouse gas emissions disclosure requirements under IFRS S2, including measurement, use of the GHG protocol, and how to report scopes 1, 2, and 3 emissions in line with the standard. Okay, So I think it's time for another example. Over to you, Lois.
Thanks, Bella. Yes, and this example shows Vale's GHG inventory, and Vale is a metals and mining company. Things to note are the tables on the left or in the middle there show greenhouse gas emissions broken down by scopes 1, 2, and 3, as well as comparative figures going back to 2022 and comparison with their baseline year of 2017. So it enables you to see trends over time. The circular diagram on the right of the screen shows greenhouse gas emissions broken down by source. So you can see that mobile combustion activities give rise to the most greenhouse gas emissions by source, followed by industrial processes. So these two types of breakdown by scope, 1, 2, and 3, and by emissions, enable readers to tell where the majority of emissions come from in terms of scope and source, and therefore to to assess other parts of the report about how the company is using its strategy to reduce emissions from those sources. Notes and symbols tell us in this extract how the results have been prepared. So you can see, for example, the little the yellow boxes that tell us where GRI standards were used to prepare information. Notes also help us understand how the inventory is being prepared. Note 1 says that the greenhouse gas emissions inventory has been assured by a third party, and Note 2 explains that the greenhouse gas emissions have been reported on a gross basis, that is before any type of mitigation or or compensation. We also see the emissions intensity figures. And at the bottom of the page, there's an overview of the company's long-term commitments on climate change and a report on their progress. So as we know, the baseline for their Scope 1 and 2 targets was set in 2017, and the aim is to reduce emissions by 33% by 2030 and to achieve net zero emissions by 2024. And what the extract tells us is that by 2024, the company had made 81% progress towards its target. And we see a similar analysis done for scope 3. Sorry, I should have said scope 1 and 2 emissions. They want to achieve net zero emissions by 2050, not 2024. So let's look at a Zoom poll now. And this is about metrics and targets. And the question is, what is the objective of metrics? In particular, what is the objective of the ISSB requirements for companies to report on metrics and targets? You can select all that apply. I can see that you know the answer to this, so I'm going to share the results. Yes, the majority of you have responded A and B, and that's absolutely correct. The reason for asking you the question in this way is to draw your attention to the fact that each of the content areas in the ISSB standards start by telling us what is the objective of the requirement. And in the case of metrics, the objective is to enable report users to understand performance in relation to the company's sustainability related risks and opportunities and to understand progress towards any targets. Now, I'm sure it's the case that such information would also help readers to understand the company's assumptions for the future, so it's useful, but we just want to draw your attention to the fact that there are these very specific objectives within the requirements, and they can help you, if you read them, they can help you to structure your disclosures and really make them answer to those objectives directly. So we're going to move on to the next part of our Align module, and this is about integrating other disclosure requirements with the ISSB requirements. This is a final section of our Align module. We've already talked about the fact that the ISSB standards represent a global baseline of standardized comparable information, but many companies already disclose against voluntary and mandatory reporting standards based on jurisdictional requirements, stock exchange regulations, or industry norms, or the needs of other stakeholders. We saw earlier that this is possible through building on the baseline that represents the ISSB standards, that these building blocks of other requirements can be added. So the ISSB is working with institutions around the world about how jurisdictional progress can be made towards adoption of the ISSB standards, and in conjunction with any specific requirements that the jurisdictions have. So we can see some of the progress that's been made here. As of December 2025, 39 jurisdictions have adopted, used, or are taking steps to introduce ISSB standards into their legal or regulatory frameworks. And there's a hyperlink within this slide if you want to know more about the jurisdictional profiles and snapshots relating to those 39 jurisdictions. These profiles complement the ISSB's 2024 jurisdictional guide that explains how they're working with different jurisdictions on their bilateral engagement and independent views. But the basic message to take from this is that the IFRS Foundation is supporting jurisdictions via consultations and their regulatory impact implementation program and the roadmap development tool to think about how they will adopt the standards. So we're going to move on to strategic relationships that support this so-called interoperability. There's going to, as we talked about earlier, CDP has aligned its climate questionnaire with the ISSB standards. The greenhouse gas protocol is the methodology that must be used for the calculation of greenhouse gas emissions, and the ISSB is working actively with the GHG protocol, both on technical and governance matters, to make sure that there is alignment between the GHG protocol and ISSB requirements. The GRI and ISSB are working closely together to deliver full interoperability between their standards by identifying and aligning common disclosures. We've talked about the transition plan task force materials being incorporated into the ISSB's work, and as already Ndidi mentioned, the ISSB is working on developing standards and materials about nature-related sustainability risks and opportunities. Just to mention quickly on the GRI, there's been a statement by the GRI and IFRS Foundation about interoperability on GHG emissions disclosures. And very briefly, what this says is that the GRI's Global Sustainability Standards Board has granted equivalence to IFRS S2 for Scope 1, 2 and 3 GHG emissions, which means that you only have to report GHG emissions by reference to one standard because they are regarded as equivalent. That's the main message to take from that slide. Now, we're going to skip over the relationship between the European standard and ISSB, but the brief messages, they are also working very closely together. Many of you I know are familiar with the integrated reporting framework, and the message to take from this slide is that the integrated reporting framework complements IFRS S1 and S2, and the ISSB has developed a guide that explains how integrated reporting can be used to support ISSB reporting. It gives a more holistic view of the value creation process and a more complete picture of how value is created over time. So if you are currently using the integrated reporting framework, please do have a look at this document if you want to understand how integrated reporting can be used to support your ISSB disclosures. Let's have a little look at a poll now, just to check with you about this question of alignment and interoperability. So your company's disclosure objectives should consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above. And I think you can only choose one of these, and I can see already that you've chosen the correct one. We've been trying to catch up with time a little bit, and you're certainly helping us with your wonderful quick responses. Yes, I'll share the results. Of course, it's D. All of the ISSB standards, regulatory requirements, and other sources of guidance, including the integrated reporting framework we just mentioned, can be used to help you determine your disclosure objectives and how to make your disclosures. So I'm going to hand to Fiona now for a Module 2 summary.
Brilliant. Thanks so much for that, Lois. So, as we said, we're at the end of Module 2 now. So I think I mentioned at the start, Module 2 is quite a large one. So don't worry, we're more than halfway through our content today. But hopefully it's been useful to dedicate that time to really just walking through each of the content areas and making sure we understood those requirements in detail. So just to wrap us up on this module, we're going to take a minute now to remind ourselves of what we've learned. So we reviewed all of those 4 core content areas of the ISSB standards. So that's governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these don't operate in silos. And we saw in our examples that despite having 4 separate categories of disclosure, they're all interconnected. And we also discussed how your disclosure might go beyond the requirements of S1 and S2. So, for example, to meet different stakeholder needs, to meet regulatory requirements in your jurisdiction, or to meet industry standards as well. And what's important to remember when we're doing this is that the ISSB standards have been purposely developed to act as a baseline. And that building blocks approach then allows report preparers to add additional disclosures on top where they need to or where they choose to do so. But of course, the balance we have to strike here is that report preparers do need to be careful not to obscure the requirements of S1 and S2 if they're going to be building on top of them. And we'll talk a little bit more in our communications section about how to structure reports perhaps in a way that can support with that. But we'll go back to Menti now to do another exercise. And so to wrap up this module, we'd like to think a little bit about how we identify gaps and understand where to move forward on. So as we've talked through those different content areas, it's probably already coming to mind for you that there might be areas of disclosure that are new to your organization, some things that you already have in place, some things you need to develop. And so, of course, we'd recommend really going away and doing that gap analysis. And we've shared that link already to the SSE's gap analysis checklist that can support you there. But what we'd like to do now is just to pause together and think about maybe what's front of mind in terms of what those gaps could be. And so there might be a different sort of gap here. So maybe some areas are around additional reporting requirements. So particular areas of disclosure that you need to adopt or particular ways of reporting that maybe you've not yet been using. There could also be things that relate to your reporting processes or skill sets as well. So maybe that requirement to have quantitative information would bring about the need for more or different controls in your organization, for example, or maybe there's a need for new resources internally or to be brought in from the external environment to help you to address what you need to think about. So what we'll do now is just share Menti again. Thank you, Lois, for sharing the link. And you can share there just a reflection really of any gaps that are front of mind for you. We'll come back to think about how we can address these in a little bit, but maybe just useful to think about what's your most priority gap at this point. What's maybe the thing that's most new for you, or maybe the things you want to focus on firstly. You can also be thinking here as well about that prioritization point. So there may be some gaps that are more significant or more substantive in terms of the necessity of addressing them before your first disclosures under S1 and S2. Maybe some of them are more so things that you can continue to progress and maybe just provide transparency on in your reporting that those gaps exist. But I hear seeing a few people mentioning here about the quantitative side of things and maybe data quality. Yeah, I think that's quite commonly an area that will be new or something to improve for many organizations. Of course, a key point we've talked about throughout today is that connectivity between your sustainability related risks and opportunities and your financial disclosures. And of course, that part of the equation is often the tough part to crack. So connectedness, I saw mentioned there as well, exactly. Someone's maybe not sure on the gaps yet, and that's okay. Of course, some of you might have a good idea already of where your gaps are. Some of you, it might just be a case of going away and needing to start to understand that. And that, of course, is where a more structured gap analysis is a very helpful exercise. So a few people have mentioned that that's maybe the case yet. They don't have any gaps to highlight. But someone's mentioned about maybe guidance on specifics around the sustainability and climate disclosure. So we'll talk about resources and guidance as we wrap up the session at the end. So hopefully we can signpost a few things that can support you there. Someone's mentioned around their governance structures. So maybe making sure that you've got that right board level and management level accountability and oversight in place. And as you've also mentioned, the data collection side of things often requires a more structured set of controls than maybe organizations traditionally had for maybe more voluntary sustainability reporting. And so I think working with your colleagues in finance and risk and aiming to adopt the same structures and controls that they have for financial accounting will be a great idea to sort of inform that approach. Someone's mentioned really embedding decisions into capital allocation and financial planning. Yeah, absolutely. That's often the really challenging part. And, to some extent, the disclosure aspect doesn't necessarily drive that because, of course, disclosure is just about putting out there what the state of play is. But we hope that at least, in collecting this information for disclosure purposes, it drives some of those conversations that can really help you to move forward on that strategic integration as well. So it's great to see you thinking about that point already and certainly encourage you to continue to progress that internally. Data, I see, and quantification. Thinking about the financial effects of risks and opportunities. Yeah. And hopefully, I think you can see in some of the examples we've shared that, of course, the financial effect side of things can start on a more qualitative basis and progress towards quantification. So, it's all about that proportionality of prioritizing, understanding best those risks and opportunities that could be potentially or be expected to be material. So also getting that initial assessment of what the risks and opportunities are to inform where you place your efforts to quantify things can be useful too. Okay, this person said a schoolgoer mindset where 50% is pass. Fair enough. Yeah, I think sometimes that's obviously realistically the state of play in your organization. I think as hopefully that point in the start about thinking about setting the objectives for your disclosure is a good opportunity to open that conversation up a little bit. So maybe traditionally the reporting might have only been seen as a bit of a box to tick. Hopefully, increasingly, it's possible to demonstrate that there are real benefits. Connecting into that investment angle, I think hopefully helpful there to really illustrate that investors absolutely want to see this information, are increasingly using it in their decision making will be a useful thing to highlight. So someone's mentioned also that they're already doing TCFD reporting, but then of course they need to now move towards using S1 and S2. So we didn't spend a lot of time talking about this today, but for those organizations who have already conducted TCFD reporting, you do have a lot of the foundations that you need here. There's a mapping document which we've shared a link to in the slides, which will also help you to see how to move from TCFD to S2 as well. So I recommend taking a look at that. So people have mentioned around the financing side again. maybe the materiality approach, and perhaps that's speaking to the similar point here about aligning with reporting standards. So, understanding if you're using a more impact-led materiality lens for other purposes as well, how you align those two lenses. I think Robert's provided some useful answers in the Q&A on that point, so I recommend looking at those responses there for some recommendations about how to move forward with that. Okay, just have a little scan. I'm seeing some similar themes, but mentioning also scenario analysis a few times here as well. Yeah, those of you who might have reported to TCFD may be familiar with that, but if you haven't, of course, this could be a new activity for you. So, yeah, of course, as you say, getting that buy-in from the top for this is very important, but obviously within the standards, the scenario analysis aspect is a requirement that you do this. There is a lot of flexibility and reliefs in place to allow you to kind of take a proportional approach and continue to progress that method. But getting started with at least sort of qualitative assessment of those risks and opportunities under different time horizons and thinking about that resilience point is a key place to move forward indeed. Great. Thanks everyone for highlighting all of these areas. We don't have all of the answers today, of course, but I think, understanding what those gaps are, of course, is the key starting point to knowing what to do with them. So some people have said, obviously, their first gap is that they haven't got a gap analysis. So, of course, that's very understandable at this point. And so hopefully we've prompted a little bit of thinking here, but absolutely recommend going away and doing that more structured assessment to help you to understand where your gaps are and to prioritize those is a really good idea. So we'll share again our gap analysis checklist that can support you on that. Okay, so I'll take us back to the slide presentation and we're going to get started on our third module, Implement Now, which I'll hand you back to Lois for.
Thank you very much, Fiona. Yes, so moving on to Implement. We've so far covered what a company has to report, so the disclosure content elements, but we're now moving on to look a bit more practically at how this is done, starting with practices and processes needed to collect the appropriate data for disclosure. There are three parts to this module. First of all, how to identify sustainability-related risks and opportunities. Second, we'll look at some evaluation processes focusing on scenario analysis. And thirdly, how to integrate processes that help with your sustainability disclosure into your existing processes and practices. So starting with how to identify sustainability-related risks and opportunities, as we said earlier, IFRS S1 asks companies to provide material information on all sustainability risks and opportunities that could reasonably be expected to affect the company's prospects, and S2 sets out the requirements for climate-related disclosures. So what about risks and opportunities beyond climate? S1 directs companies to sources of guidance they can use to support the identification of risks and opportunities and the information to disclose about them. So first of all, when identifying which sustainability related risks and opportunities to report beyond climate, S1 says that consideration must be given to SASB standards, so the sector-specific standards. In addition, companies can consider other sources of guidance, including the IFRS educational material on sustainability-related risks and opportunities and disclosure of material information. That's very comprehensive. They can look at the Climate Disclosure Standards Board framework application guidance that includes information on how to disclose on water-related risks and forestry and some social and human rights related issues. The companies can also look at industry practices, perhaps if they belong to an industry body that has developed sustainability-related guidance specifically for that industry, and the materials of investor-focused standard setters, and that would include integrated reporting, for example. Then, having looked at those sources of information to identify which risks and opportunities to focus on, the same sources of information can be used to identify what to report about those risks and opportunities. But in addition, companies can look at the GRI standards and the European sustainability reporting standards. So we saw this, didn't we, in the example we saw earlier when CLP disclosed information about its strategy, metrics and targets on waste management and pollution reduction. They had used the SASB standards and the GRI standards to develop their disclosures. So that was a real life example of this guidance in operation. Let's look at another example now. This is an example from a company called Ayala, which is a Philippines-based conglomerate that encompasses lots of different business activities. It's from their Integrated Report 2024. And what the extract shows us is the process that the company uses for identifying risks and to the business. There's a four-part process, but it's informed by a program of communication and consultation that the company takes across different internal business units and with other relevant stakeholders. And it also learns from what the company did in previous years. So the first step is to establish the context within which the company operates, including looking at sources of risk intelligence from global risk reports, subject matter experts, and the management team. So this helps the company understand the emerging risks and trends in the context in which they operate. The second step is to identify, analyze, and evaluate the risks concerned. So how are they prioritized? And we can see that the risk management team is in charge of that part of the process. Thirdly, the company decides how to treat the risk. And finally, what processes will be put in place for monitoring and review of the risk. And you can see that one of the outputs from that monitoring and review step is to update IR's risk portfolio, their periodic management report and their annual risk management report. So they've really embedded sustainability considerations into their risk framework so that they can anticipate and respond to sustainability risk while also identifying opportunities for long-term value creation. We'll look at another example now, and this is an example from a company called Nest, which is based in Finland and is a producer of sustainable aviation fuel and renewable diesel and feedstock solutions for the chemical industry. Now, this process is slightly different from IALA's. It's used to identify both risks and opportunities using scenarios. So there are two scenarios the company uses, the net zero world, which is where rapid and radical emissions reductions take place globally by 2050 with a view to limiting global warming to 1.5 degrees above pre-industrial levels, and using the IEA's net zero 2050 scenario. Now, I should point out that the net zero scenario is also analysed for the EU and North America, as you can see down below, and that's because the transition will take place at different paces and in different ways in different jurisdictions. So by using this net zero by 2050 scenario, the company has identified opportunities for itself because it's in renewables, the renewable business. So it anticipates accelerated global demand for renewable and circular solutions. Then they have another scenario that they use, which is called the compromised climate target scenario, where climate action is slow and global warming of between 2.5 and 3 degrees above pre-industrial levels is expected. And in this case, the company has opportunities to differentiate itself from others by providing renewable and circular solutions, but it also faces the risk that demand for those products will be constrained. One other thing to notice about this example is that having identified risks and opportunities using scenarios, the company also gives us an indicative financial impact in each case. And you can see that the most positive impact is in net zero world 2050 because the most opportunities are identified in that particular scenario. So what these previous slides show us is that risks can be identified using a process, as we saw with Ayala, using resources, as we saw with the first slide, and those resources are referred to by the IFRS standards, and also by using scenarios. But of course, the standards recognise that it can be difficult to identify risks and opportunities. It's a challenging exercise, albeit very valuable. So to make sure that the effort involved is proportionate, the ISSB standards again use this phrase to tell us that the company only has to use all reasonable and supportable information available at the reporting date without undue cost and effort. So what is reasonable and supportable? It's information that's specific to the company. So the company will know it because it's specific to itself. It's not just generic information that applies more widely. It takes account of the external environment. We certainly saw that in the Ayala example where that was the first step in their process. It includes information about past events, current conditions, and forecasts, perhaps using scenario analysis, as we saw with NEST. And in some cases, the what is reasonable and supportable is specified by the IFRS disclosure standards. So let's move on to the second part of our implement module with Fiona.
Great, thank you so much for that, Lois. Okay, so once those risks and opportunities have been identified, the company then needs to evaluate the financial effects of those risks and opportunities. And we know this can be a little bit of a daunting exercise, so let's see if we can look at a few key concepts to help get us started here. So thinking about resilience and uncertainty, under S2, companies are asked to disclose information about the implications of climate change for the strategy and business model. And this is thinking overall about the company's financial and operational capacity to adjust or adapt over the short, medium, and long term. So to do this, you'll need to use climate scenarios which draw from science and analyze how those will lead to effects for the company. And it's important to remember for scenario analysis that we're not asking you to predict or forecast the future because we're not ascribing any sort of likelihood to these scenarios. What we're really just asking you to do is to project what's plausible as a possible future. And that helps us then to build resilience and adapt our strategies to allow them to be hopefully more flexible to those plausible possible pathways that we could see. And so the ISSB's approach here asks companies to use an approach that is commensurate with their circumstances and that uses all information that's available to them at the reporting date without undue cost or effort. And scenario analysis is something where we see a number of examples coming through from practices, particularly the companies who had adopted the TCFD recommendations may have already progressed. So there's lots of good examples out there to help give you some inspiration about how you could get started on this. And this one we're showing here comes from the food and drinks company Nestle. It shows how they've projected the impact that climate change the impact that climate change could have on the yields of some of their key agricultural commodities globally, and whether they might expect to see an increase or a decrease in different emission scenarios in the yields of those commodities. And that's helping them to better understand the potential volatility they might see in their supply chains in the future, which could cause supply chain disruption, potential cost increases, etc. And so alongside this scenario analysis, they show the impacts that this then has on their business and strategy and how they're starting to think about integrating these insights into their financial planning to increase their strategic resilience. And of course, when we're talking about the materiality of potential future events, this can be quite challenging to determine. So there's a number of points that are set out in IFRS S1 that ask a company to really just continue to evaluate these uncertainties. So it's understood and accepted there will be uncertainty, but what's important is that you work through each reporting period an assessment of what those uncertainties are. And so you can continue to report within your disclosures on, where any adjustments or reassessments might be needed. So there's a highlight here of just some of the points that should be considered. And it's important, as we say, just to provide transparency about the assumptions, the methods that you've used for scenario analysis, and where any residual areas of uncertainty may lie. Okay, so that wraps us up on that segment, and back to you, Lois, for the final part on integration.
Thanks very much, Fiona. Just looking at some of the questions there. So we're going to move on now to look at how and whether new processes need to be developed to help with sustainability disclosure. Now, the good news here is that in many cases, a company will already have a set of processes and practices that might well be useful for developing sustainability disclosure. The sorts of things that you might want to ask yourself when thinking whether you have got enough or you need some new process or you need to adapt what you already have is to conduct a gap analysis. And we've already discussed that in some of the Menti exercises. Then have a look at whether existing processes are suitable for identifying sustainability-related risks and opportunities, and whether the criteria used for assessment and valuation are suitable. As we know, sustainability-related risks and opportunities are uncertain in terms of the timescale over which they will manifest and what their exact effects will be. So do you need to add prioritization criteria to existing processes to take account of the potential impact of the risk or opportunity, the company's vulnerability, and the speed of onset of the risk or opportunity? Consider what existing internal controls could be used. Do you remember the BMW example? We saw that the controls processes were closely aligned with risk management when looking at sustainability and other risks. Which contributors might need to be involved in developing your processes for sustainability disclosure? Which departments have processes, practices, systems, and expertise that could contribute towards disclosure activity? What are the interconnections between different internal and external factors? We've seen that in some of the examples, haven't we, that the process will involve looking at both the external context in which risks arise, but also internal expertise. What uncertainties are associated with the evaluation, monitoring of sustainability-related risks and opportunities, and how will they be dealt with? And finally, what resources are in place to manage existing processes or develop new ones? Do you need to go through a budget request process to get extra resource or some sort of change management process? All of these points are relevant when considering whether you need to develop your processes. And that's why we have suggested as your homework that you use a disclosure plan to help support your disclosure activity. Now, a disclosure plan is a great way to integrate sustainability related risks and opportunities and disclosure considerations into an organization's wider practices and processes. It can help a company to take control of its narrative by being very specific about how these risks and opportunities affect the company and its strategy and its business model and its targets and decisions. It supports internal collaboration by being a permanent record of where knowledge comes from, how knowledge is shared, what cross-functional team discussions need to take place in order to support disclosure. And most importantly, it creates a reference point and audit trail, including where and how judgments have been made. So what we're anticipating here is a written record that describes the company's reporting goals and objectives, which laws you have to comply with, which standards you've chosen to use, how different goals and requirements will be managed, which audiences you're reporting to and why, who will be involved in developing the disclosures, which individuals and departments, and how will they be organised and how will their responsibilities be described? How will you source data? And which existing systems and controls will be used to ensure that that data is reliable? Will you get assurance on any or all of the sustainability information from whom? And importantly, what will be the sign-off disclosures for your sustainability, the sign-off processes for your sustainability disclosures? All of these things can be recorded in a disclosure plan, and we're going to look at an example now where Novo Nordisk, a Danish pharmaceutical company, describes the basis on which they've prepared their sustainability statement. And the types of things that they tell us in this extract are the types of things that we would expect to see in a disclosure plan. So they tell us that they tell us which regulations, standards, and practices that they have to or have chosen to use for their disclosures. And you can see quite a long list in the second paragraph there that they're using the Greenhouse Gas Protocol, the Science Based Targets Initiative, TCFD, and so on and so forth. And in this extract, the company also explains the approach and scope they've used for data collection and verification for its reports, why and how changes have been made to their reporting, including how they've corrected errors, the time horizons they've considered for preparing information, and in the third paragraph on the left, they actually define what they mean by short, medium, and long term. On the second panel on the right, they tell us about where estimates have been used and how to find more information about the assumptions and uncertainties that inform those estimates. And there's lots of contextual information in here that helps the reader to understand how the data has been prepared. So you can imagine, can't you, that agreeing this before starting on the reporting year, before getting started with data collection, is going to be really helpful so that you have a structure and process to follow and there's no surprises at the end. Just imagine having to go back and collect all this information just before the report is due to be finalised. So let's have a look at a poll now to end this little section. And the question is, you can only answer yes or no, is a disclosure plan required by the IFRS sustainability disclosure standards? You can answer yes, it's helpful, or yes, you must, or no, but it's a helpful tool. I can see that you know the answer, so I'm going to share the results. The answer, you are correct. The answer is no. We suggest it as your homework because it's very helpful to have a disclosure plan for your internal organization. There's no requirement in the IFRS standards to have a plan, although there are specific requirements that ask you to disclose, for example, the methodology that you have used to prepare information. So a disclosure plan will help with those specific requirements in the ISSB standards too. So we're going to hand over to Fiona now for the Module 3 summary.
Great, thank you, Lois. Brilliant. So back to me for another roundup. So we're into third of 4 modules now as a summary. So to wrap up on a few of the key things here, firstly, let's start with connections. So in the last module, we highlighted the importance of connection between the 4 core content areas of disclosure. And then in this module, we were also talking about the many connections that exist between a company and its external and internal environment as well. And so it's those connections that we need to focus on in order to identify our key sustainability related risks and opportunities. And the second thing that we talked about in this module was relating to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. And as we've talked about, scenario analysis is a helpful tool and indeed one that's required as part of S2 for a climate-related resilience assessment. But it's important that if we're using scenario analysis, that we're keeping track of those assumptions that we've used and that we provide information in our disclosure to summarize what those assumptions are. Excuse me. And then finally, as we've seen, even if some of this data is not data that you're already disclosing, oh, I think you can hear I've got a frog in my throat, just a second. Excuse me. Even if some of this data isn't data that you're already disclosing, it could be that you're already collecting it for different reasons. Or maybe you do have practices in place that can help you to collect that data. So wherever you can, making adjustments to your processes, but not starting from scratch is much appreciated. Excellent. Okay, great. Thanks, everyone. And thanks for the love. I'll have my little, throat moment. So we're going to have our third Menti exercise now. And we're thinking here about the practices and systems that we want to put in place for data collection. So as I've mentioned, it might be that you already have some systems that you can use. It may be that you have some sources of information that you can think of already that could help you to collect information. And it might be that you can maybe adapt existing processes in some ways. So we'll take a moment just to reflect on what some of those processes and sources might be. I know many of you mentioned that kind of data was probably a key concern or gap that you had. But I'm sure if we think about it together, we might actually realize that there's quite a lot that we'll probably have access to in our companies that can help us here. So great, I see lots of responses in already that can support everyone else in thinking this through. So hopefully some of these ideas might even be ones that you could use in your organization. So someone's mentioned leveraging existing processes first and then building on them. Yeah, so that's a good idea. Someone said have metrics first, then gather the data. So I think by that, maybe you mean decide what metrics you want to report, and then you can work back from that to understand what data that you need to gather to support you in reporting them, which, yeah, that's a good logical approach. Someone's also mentioned using the kind of accounting information, so looking at their accounts payable, shipping records, and their ERP system. So yeah, all good sources, exactly. So lots of things that you have on an accounting or operational basis will give you relevant information to be assessing and reporting on these risks and opportunities too. I'm seeing a mention of internal controls and risk information, definitely a good point. So you probably got risk registers at various levels of your organization. There are probably many things in those risk registers that may not be framed as sustainability risks at the moment, but actually are highly pertinent to this topic. So reviewing with colleagues who are managing the risk processes is likely a really helpful point, and indeed using that ERM process to support the assessment of new risk types as well. So I'm seeing energy usage mentioned as well. Someone's also mentioned about primary and secondary methods. That is a good point. Within the standards, there's sort of a hierarchy of prioritization. So if you have primary data, then of course that's great to use. But indeed, it is acknowledged that particularly from your value chain, getting actual data can sometimes be challenging. So there are different options to use in terms of proxies or estimation methods, industry averages, etc., that can help you to at least build a picture of what your risks and opportunities are and kind of what your performance is to then evolve and build quality over time. Great. Lots of good ideas here. I'm seeing reference to maybe using IT platforms, maybe speaking about audit and controls, putting those in place for your carbon accounting and software, using industry reports. Lots of great ideas. So I see a few people saying they're not sure, but I think loads of great responses here from some other participants. So thanks for those who've shared. So I encourage you to scroll through this and hopefully gives you some inspiration. But I think the point here is well captured, that there's a lot out there that you'll be able to use in your organization. So probably just doing a bit of a mapping exercise to understand what you already have and what you can use here will be really valuable. So building off that as much as you can, but then maybe prioritizing what areas it is that you need to understand better. Great. Thanks everyone for lots of great input. Again, that's super helpful. So we're now going to be moving into our fourth and final module on communication. So I'll just get our slides back up and I'll hand over to Robert, who can take us through this section.
Great, thank you very much, Fiona, and welcome everyone. Um, Indeed, we'll be now moving to the final module about communication, how to communicate your disclosures, and also which focus on when and where of the disclosures information. So in this last unit, we have three main sections. To get started, we'll first look at location to clarify where sustainability disclosures should be located. Well, before going into the details and specific requirements, let's think about sustainability disclosures, the content of a complete reporting package that is useful to investors. The requirements of in the ISB standards are based on investor information, as we specified multiple times today. Information needs, and they build on past frameworks and standards such as TCFD and SASB, which are similarly focused on investor needs. One of the major advancements in the ISB standards is bringing the rigor of accounting as well as connectivity to the financial statements. So that's on the left-hand side. On the right-hand side, we let's talk about the relationship between ISB and GRI standards, as they do share content requirements, and this is what to report, but with different objectives. So the ISB standards are laser focused on investor needs, information, and needs and decision making. That is information about sustainability-related risk and opportunities that could reasonably be expected to affect companies' cash flows, access to finance, or cost of capital. The objective of the GRI standards, on the other hand, is to elicit information about companies' impacts, regardless of the implication for those impacts on the company's performance. So, as a result, the both standards, ISSB and GRI, take a different and you might say complementary approaches to materiality. The GRI approach is commonly understood among sustainability practitioners, whereas IFRS approach is familiar to accounting, finance teams, investor relation professionals, and relies heavily on the management judgment. In short, many of the impacts traditionally identified as material in the GRI standards may also give the rise to sustainability-related risks and opportunities that are likely to affect companies' prospects, and therefore investor might need information about them. So there is a relationship and a connection between the two, and they can work together. All right. So now let's focus a little bit more, and again, on material information. And this concept is fundamental and basic, but there might be some misunderstandings here occurring. So let's go through this. What is the material information? As we discussed already in the first model, information is material with it influence decision making of the primary users of the general purpose financial reports, and informs the decisions about providing the research to the company, buying, selling, and holding any debt instruments, granting loans and other forms of credit, voting on or influencing how management uses a company economic resources. In this context, when preparing disclosures, we need to consider the characteristics of the investors and the company's own circumstances. So, for example, different investors can have a different and sometimes conflicting information needs. Sustainability-related financial disclosures are intended to meet the common information needs of the investors. One important thing to remember here is that materiality is a characteristic of information. So the ISB standards take a two-level approach, which sustainability-related risk and opportunities would investor expect to affect the company's prospects, and then what material information do they need to base their decision on. So first you need to identify the sustainability-related risk opportunities, and then to decide what is the material information which needs to be disclosed. So here it's important to maybe think about it that materiality is not the label on the risk, is the filter on the disclosure. And this concept is there in order to meet the consistency with the definition of materiality in accounting standards. So please do remember about this important distinction. So in the next slide, I'll be talking about disclosing material information. So IFRS S1 requires that material information to be clearly identifiable and that it's clear and concise. Material information, in other words, should be not obscured by other non-material information. So let's briefly talk about why is it important. First, the location of sustainability-related financial information within general purpose financial reports might vary between companies across different jurisdictions. Second, information designed to meet the needs of other stakeholders, in addition to investors, might be provided voluntarily or meet regulatory requirements. So the potential problem here is that material information could be obscured because it's buried amongst the immaterial information, or because the report is poorly organized and material information is scattered throughout the report. So company may not assert compliance with ISB standards if a report is overloaded with irrelevant data, or if it blends information for different audiences without clearly identifying material information for investors. That could happen if other standards and frameworks are mixed, especially if there's multi-stakeholder focused. As we mentioned previously, November 24, the IFRS released educational material with guidance for companies on identifying and disclosing material information on sustainability-related risks and opportunities, which we encourage to look for further detail. Okay, so we now will have another example to test your knowledge and understanding of the aspects we just covered and discussed. So the question here is information should be disclosed in the annual report when applying SB standards if A, B, and C. If omitting, that information could reasonably be expected to influence investor decisions. B, it could reasonably be expected to affect companies' cash flows. C, it exemplifies the values of the leadership team. And if you were listening carefully, you will have no problem to answer this question. So I'll give you a moment to answer. So please do select all answers which apply here. And yeah, I see that most of you are answering this correctly. I'll end up the poll right now. So yes, obviously the A and B are correct. These are the criteria you should think about when disclosing material information and according to SB standards. This is not about the values of the leadership team. All right. Moving further, now we will then talk about what's the core message in this unit, in this section of this unit. So the location of the ISB disclosures. So disclosures under ISB standards must be made available at the same time, on the same terms as the financial statements. That is, as a part of the same general purpose financial reporting package. However, as one does not have a requirement on the exact placement on the information, does not say where within the reporting package the information shall be provided. This is allowed to jurisdiction to decide on the location. The most important factor to consider here is to ensure the sustainability disclosures are for the same reporting entity as the related financial statements, and are published as a part of the same general purpose financial reporting package at the same time as the financial statements. In the 2023 WBCSD on the state of integrated reporting showed that nearly 2/3 companies continue to put sustainability reported information in standalone reports. And so that's clearly an indication that this is not, there's still work to be done, because the ISB standards require sustainability related financial disclosures to be included within the general purpose financial reports. So this is important to, and we had a couple of questions in the Q&A about this as well. All right, and again, to illustrate this, we will have an example which will be presented by Lois. Lois, over to you.
Thanks, Robert. And this example about where companies report sustainability information is comes from a study done by the World Business Council for Sustainable Development, and it's from their 2025 report called Reporting Matters, which is their annual review of corporate reporting from a selection of global companies. So what this shows is that standalone sustainability reports remain the predominant approach in 2025. So you can see on the top bar there, 54 reporting is 54% comprised of standalone reports in that year's example, but that is down from 59% in the year before and 62% in the year before that. So what it shows us is that the incidence of standalone reporting is going down from in 2025 compared with 2023. So this probably confirms the shift towards reporting financial and non-financial information within the same document, and this could be motivated by mandatory requirements in some jurisdictions. You'll see that standalone reports are further subdivided into combined or integrated, and mainly this is a way of distinguishing between companies that do combine financial and non-financial information and self-reported integrated reports prepared according to the integrated reporting framework. At the bottom of the slide, in the green bars, we can see more of an analysis of reporting practices in different regions. So standalone sustainability reports still predominate in the Americas, representing 81% of reports. In APAC, there's a mix of sustainability and self-declared integrated reports. That's 58% in APAC and 39% in EMEA. So the regional differences are likely to do with different regulatory contexts. So have a look at reporting matters if you want to know more about that. But this does presuppose that companies are reporting in PDF format. Of course, there's an evolution towards digital reporting, and Robert's going to talk to us about that next.
Yes, indeed. Thank you much. Thank you very much, Lois. Yeah, we'll be talking about now the evolution and the format of the disclosures, as this is also affecting the sustainability disclosures. So it's worth noting. So the ISSB has issued ISSB taxonomy. So it's worth noting here that the taxonomy is a general rule for the classification system. You may also hear about sustainability finance taxonomy, such as the EU taxonomy. This type of taxonomy relates to the classifying the sustainability of different types of economic activity or investments. So now, when we talk about the ISSB taxonomy, we are referring to a different type of classification system used to categorize information within the reports. So increasingly, corporate reporting is moving, as Lois mentioned, from PDF reports towards information on web pages with structured data sets, such as those data sets used by stock exchanges or regulators. So to respond to this reality, the IFRS Foundation developed the ISSB taxonomy. The ISSB taxonomy provides identifiers or tags based on XBRL, extensible business reporting language, needed to make sustainability disclosures machine readable. This makes it easier for investors and data platforms to take large data sets like information from entire industry, for example, and bring them all together to analyze them. So digital reporting has several benefits. First of all, it makes the reported information easier to use for analysis because data is structured the same structured the same across businesses, sectors, and geographies in a machine readable format. Second, tagging information potentially allows for automated checks for quality and consistency. And third, it improves processing and report preparation as more data collection and management systems are compatible with digital reporting taxonomies. And finally, tags can have labels and descriptions in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. Right, so that was about we finished the first section in this module, and we'll now talk about effectiveness and how to communicate efficiently and effectively. So following the discussion on the timing and location, we will now see how to address the requirement or the danger or the threat of the growing reporting burden. So we now hope to highlight here that when done correctly, efficiencies can be made to reduce that burden. So let's find out what is effective communication. So it's important to understand um, what is here required. So often companies think that if they just put all the information they have into reports, that everyone will be satisfied. However, this would be against the core concepts, in particular for presentation. So S1 requires information to be clear and concise, as we mentioned already. So the clearest form of disclosure will depend on the nature of the information. For example, tables, graphs, and diagrams, plus accompanying text. To be concise, disclosures need to avoid boilerplate information, unnecessary duplication, and use clear language. So, what would the quality of the information disclose? What are the criteria here? So, when we talk about the quality of information to report and how traditionally disclosures of sustainability information and financial information has been different. Accountants in the audience are probably familiar with the rigor that is required in data collection, that there's an oversight, a sign of this external assurance for general purpose financial reports. And the same level of rigor has not been traditionally linked with the sustainability information. So, for example, comparable information from the previous reporting period is the requirement in the ISSB standards, except during the first year of implementation, and must be revised if necessary. So, as we discussed in the previous section, the ISB requires that reported information shall be material and that companies provide connected information, including highlighting connections between risks and opportunities, the core content, and of course between sustainability-related risks and opportunities, and financial statements. When aggregating information, items of information shall be aggregated if they have shared characteristics, and disaggregated if they do not. A company shall not aggregate information if doing so would obscure material information. Companies should also avoid unnecessary duplication and cross-reference when this is appropriate. And we'll spend a little bit of time now about talking about cross-referencing. As you may have already noticed, there might appear to be some overlap in the topics covered and the information disclosed across different reports or section of reports. And in fact, as one it requires you to avoid unnecessary duplication. So for example, you have the same governance approach across all sustainability issues. You need only disclose it once, or if information required by ISB standards is in another report that you publish, for example, in related financial statements, then you can include material information in your disclosure by cross-reference, provided the other report is available at the same time and on the same terms. Cross-referencing should also be applied consistently and transparently. It shall not result in the information becoming obscured or more difficult to understand. And to show you how this might work in practice, we have another example and presented by Lois.
Thanks, Robert. Yes, this is just a quick example from ArcelorMittal, which is a multinational steel company. And it just shows how they manage their cross-referencing in their report. So down the left-hand side, in these two columns, the first column, you can see content elements and concepts with which you are now very familiar from having done this training. So content elements like governance, risks and opportunities, strategy and resource allocation listed down the left-hand side. Then on the right-hand side, you can see where they have put information about this. So they're referring here to IFRS content elements and concepts and their own Sustainable Development Goal Index. You can see that, for example, in governance, they are referring to the governance and risk management section of the sustainability report that this index table appears in. In other cases, for example, risks and opportunities, as well as referring to the governance and risk management section of the sustainability report, they also refer us to their Form 20F, which is a US registration document that they're required to complete. So some references are to sections within the document, some references are to other documents, but it's just a simple way of basing their cross-referencing index on the IFRS content elements and concepts, and then showing us exactly where information is about those concepts and content elements. Back to you, Robert.
Yes, thank you, Lois. We'll be now moving to some mechanisms that support adoption. So the preparers might have a different stage of the preparedness for the disclosures. So the ISSB has thought some about some measures how to make it easier in your first year of the adoption. So first of all, let's start with that one simple thing to make it easier to apply the ISB sustainability disclosures is that we adopt the well-known terminology and concepts familiar to preparers and borrowing from the IASB, for example. So that's the first one. Secondly, many requirements in S1 and S2 are to be applied proportionately, recognizing that companies will have a range of capabilities and preparedness on these issues. So qualitative scenario, for example, is permitted if you will see the phrase all reasonable and supportable information and at the reporting date without undue cost or effort. Or the other one, commensurate with skills, capabilities, and resources in the number of places. So if you see this phrases, you know that that this proportionality mechanisms are being available here. And there are a number of reliefs also for the first year of application. And these are, for example, that companies are being able to limit the disclosure to climate in year one and begin reporting on the other sustainability related risks and opportunities in year two. The other relief is that companies are also able to provide annual sustainability related financial disclosures with their next half year reporting rather than at the same time as the financial statements. And finally, there's another relief regarding the scope 3 greenhouse gas emissions to apply the greenhouse gas protocol corporate standards to measure emissions. If they are already using, they don't need to use the greenhouse gas protocol standard if they are already using a different measurement approach or provide comparative information in the first year of reporting using S1 and S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies with a different reporting cycle. We also mentioned a number of other resources of guidance, including SASB, CDSB framework application guidance, among many others. So these release and proportionality mechanisms and sources of guidance are designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. Right, I'll be moving now to the last. We'll skip the zone pause to save some time because we're slightly lagging. So we're now moving to the very last unit of this module, and we'll be talking about um, confidence and how the reports can increase the confidence in the data you are disclosing, as a trust is essential component of sustainability related disclosures, and increasingly so with growing concept of greenwashing. So one important trust builder is showcasing data and trends over time. So S1 requires that you disclose comparative information for the preceding period for all amounts disclosed and for qualitative or narrative information as well if useful for investors. So comparative information provides context, helps to indicate progress and underpins strategy and risk management, and it can be both qualitative and quantitative. Metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. In this situation, it is important for the company to revise the comparatives to enable investors to compare and analyze the current period figures with the relevant previous period figures. If you have information for last year, for example, you obtain your actual greenhouse gas emissions data from your supply chain that you had only estimated before, then you should revise that information if material. And if there are material errors, in this situation, the company is required to restate these errors in the comparatives period. So revisions or restatements are necessary only when there is a risk of material information. So again, if this is when being omitted, misstated, or obscured because of not revising or restating these comparatives. And very last matter here to mention is about statement of compliance. So again, in order to build the confidence, that statement of compliance needs to be provided. A company that complies with all requirements is then required to make such a statement. I want to emphasize that you can still make a statement of compliance if you are using transition reliefs, the one we discussed in the first year of the SB reporting, or if you're using any proportionality mechanism. There are two exceptions where the information could be omitted and you could still make a statement of compliance. So that's about commercially sensitive information and when law or regulation prohibits disclosures. Companies that are beginning to phase in ISB standards voluntarily are only partially aligning to them could not make the statement of compliance, but instead may explain where they are on the path, as explained in a guide published in 2024 on voluntarily applying ISB standards. All right, to wrap up this last unit, some things to remember about disclosing effectively, efficiently, and building confidence. Follow the requirements for fair presentation and conceptual foundation of S1. These include the fundamental characteristics of decision useful information that is relevant, that is material, and that is faithfully represents what it says it does by being complete, neutral, and accurate. Then there are enhancing characteristics of information that is comparable, verifiable, timely, and understandable. Make sure information is provided so investors can understand connections between risks and opportunities, between disclosures about them, and of course, between the financial statements and sustainability related financial disclosures. And finally, the ASB disclosure should be for the same reporting entity and the same reporting period as financial statements published at the same time with complete material information, comparatives for the previous period, and statements of compliance. You can find the handout slide deck, an additional slide in this section with reminders on how to report effectively, and I highly recommend reviewing that. And with that, I'll be handing over to Fiona for the Module 4 summary. Over to you, Fiona.
Great, thanks for that, Robert. And as you say, that brings us up to the end of our last module. So we'll now be wrapping up the session as a whole. So just to recap on this module, firstly, So, firstly, we discussed where to report information. And I think what was important here in particular was the audience. So, making sure to be clear from the start who the primary user of this information will help us to ensure that information is right for their needs. And of course, in the context of S1 and S2, we're talking about investors. We then discussed efficiency, and I think a key takeaway here is that less is more. So the objective is not to overload investors with information, but really to focus on what's material information for disclosure. And of course, using the ISSB standards is a guide that will help us to deliver that result. And finally, Robert talked to us there about report user confidence. And of course, it's important to ensure that our data is not only accurate, but that it's presented in a way that builds confidence among report users. And so that's where this disclosure plan that we've discussed throughout the session today, and which you can take away optionally in the homework to further develop, can really support you. Okay, so I'm just going to skip through. We did have a last exercise, but we're a little over time, and I want to make sure we've got time for our final points together. So I'll just mention in Menti, we have a scale available for you to rate how comfortable you are with the tasks that we started off the beginning of the session with. I can see from those who've responded, overall, we're sort of getting more towards the 3 and the 4 out of 5 on the comfort scale, but encourage you to vote in Menti on that final question just to let us know where you think you're at now. But to wrap up the session, firstly, I'll just highlight the homework plan. I see a few questions about this. The homework is not mandatory and there's no need to submit that to us in any way. So this is really just an optional activity that you can take away in your own time if you'd find it valuable. So we've shared the link a number of times to where you can get the homework, and we'll share that again in the chat. But just to mention a few final resources in closing. So firstly, we have the IFRS Knowledge Hub, which is a great go-to for all of the materials from the IFRS that we've discussed today. So please be sure to check that out in the slide presentation. And then another great resource that we'd like to highlight as we close the session is the materials of the IFC's Beyond the Balance Sheet programme. And as I mentioned at the start, we're pleased to be joined today by Nomkosi, who is a corporate governance specialist based in South Africa with the IFC's team. So she's leading the IFC's corporate governance work in the market. So thanks, Nomkosi, for joining us. And I'll just hand over to you to say a few words.
Thank you so much, Fiona. Apologies about earlier. I'm having some technical difficulties. But good afternoon to everybody. My name is Nomkosi Kwela. I'm a corporate governance officer with the corporate governance unit at IFC based in Johannesburg. It has been an absolute pleasure to join you today for this workshop. Thank you for your active participation and thoughtful engagement throughout the program. This session is a reflection of the strong and growing partnership between the UNSSC initiative, the IFRS Foundation, and IFC's Beyond the Balance Sheet program. So for IFC, disclosure and transparency are quite critical. As the largest global development institution that's focused on private companies and financial institutions, we need to make informed investment decisions, and we do heavily rely on high quality, reliable financial and sustainability information from you, the companies and institutions we support. The ISSB standards have played a unique and transformative role in this work, as the standards have brought a much needed consistency and convergence to sustainability reporting, as well as a focus on high quality, decision useful information for investors. So IFC is currently actively supporting more than 10 of these jurisdictions, 10 jurisdictions to adopt the standards. And through our regional corporate governance programs, we're working in Peru, Bangladesh, Nepal, Jordan, Pakistan, and now South Africa. Specifically, we have assisted with the development of the JSE Sustainability Disclosure Guidance, and now are working on the ISSB adoption by supporting the Financial Sector Conduct Authority in its journey toward ISSB aligned adoption. We are very encouraged by the work of the Adoption Readiness Working Group here in South Africa. which is currently working towards a national adoption roadmap. And we as IFC are coordinating closely with its implementation partners, GIZ and UNDP. So as you can see on the slides, I want to introduce you and highlight the IFC's Beyond the Balance Sheet program, which is our innovative platform developed as a public good for companies and banks to strengthen transparency and sustainability reporting in emerging markets. This platform provides a framework and guidance through various resources to enhance and improve ESG disclosure. And companies and individuals of any size can access a practical toolkit that offers how-to guidance and practical examples relating to the standards requirements. We also recently launched a free e-learning program that anyone can register for, and a diagnostic self-assessment tool that companies can use to help identify gaps and in their annual reports. We also offer hands-on advisory support as part of the program. And to date, we've reached more than 40,000 participants in over 100 markets. And our goal is to simply help companies and financial institutions integrate sustainability into governance, strategy, and risk management. So you can scan the QR code on the slide to access the resources, and feel free to reach out to me for any support IFC can provide. Thank you again for joining us today, and thank you Fiona and the other organizers and facilitators for delivering a well-structured and meaningful workshop. Over to you, Fiona.
Brilliant. Thank you so much, Namkosi, for closing that out, and fantastic to hear about all the support your team are providing in the market. So thanks so much for highlighting that in closing. I'm sure lots of useful content there for our participants. I think I saw a mention already that some are benefiting from these materials already. Great, thank you everyone. So I know we're very close, or we're just over time almost, so I'm going to skip very quickly through a few of those slides. But I know a very important point we've not touched on yet is how to get your completion certificate. So Lois has just shared a link with you in the chat. That provides a link to the feedback survey. You'll need to complete that feedback survey in order to get your certificate, as that's where we send them out to you from. You'll also receive that certificate link, the survey link, again in an email from Zoom in 24 hours time. So keep an eye out for an email as well, just in case you missed that link, but it's there in the chat now. So take part in the survey and we'll send you your certificate. Please give us up to a week to receive your certificate. We send those out on a weekly basis after you fill out your survey. But great. So just to close things out, I'd like to say a few final thank yous. Firstly, to the SSE's official supporters, and of course to all of our partner organisations today, to the IFRS Foundation team, and especially to Bella and Robert, to the IFC and Nomkosi and her colleagues, and of course to the team at JSE, including Loshni and Gabrielle. Thanks so much for making today's session happen and bringing us all together. And of course, last but not least, a big thank you to all of you who've taken part in today's training. We really appreciate all of your engagement and input throughout the session. As I've shared in the chat, we do have another training session taking place in your market next month on gender equality. So I'll just post that link again, but you can also sign up for that session on the SSE website if you're interested. Hope to see you there, but otherwise we'll close off there and wish you all a fantastic end of your day. Thanks again, everyone. Take care.